All right, well, we can go ahead and get started. So good morning, and thank you all for joining us. Welcome to our third public workshop on the implementation of Senate Bills 253, 261, and 219, which we refer to as the 200s. My name is Jordan Ramalingam, and I'm the branch manager overseeing the team that is implementing the 200s. Today, we will present our progress since the previous workshop in August, outlining the implementation of the statutes and offering further guidance on reporting requirements for covered and reporting entities. And a lot has happened since the August workshop, and staff have released a number of resources aimed at developing a robust program and seeking feedback. And your feedback on these materials has been very helpful, and we appreciate your engagement. In fact, we have received close to 500 comment letters, over 900 inquiries to our climate disclosure emails, and not to mention thousands of attendees at our previous workshops, and as is the case, it looks like today. And as stated at the August workshop, we want to hear from you, from all of you, and we're doing our best to keep up. But please be patient with us as we navigate all the feedback and the requests we have received for one-on-one meetings. Today's workshop is intended to help clarify items related to key definitions, discuss the scope of the initial proposed rulemaking, and touch base on 261 compliance. In tandem with the slides that we posted yesterday, I also want to highlight that we posted an updated FAQ document in response to questions we've been receiving, as well as some very minor updates to our 261 checklist. Both of those things should prove helpful for covered and reporting entities. And we'll discuss these in more detail during the presentation today. Again, we welcome your input and engagement during this process to ensure that we ultimately implement a program that is efficient and effective, and that our collective efforts deliver greater transparency to California investors and stakeholders. So first off, some housekeeping and workshop logistics. This workshop is being recorded, and we will post that recording on our webpage as with our past workshops. All workshop materials are available at the link shown on this slide, and today's public workshop is being held fully remotely on Zoom. You will be able to raise your hand in Zoom to speak during the public comment period after we finish the staff presentation. And as is our practice, we'll call on people in the order that they raise their hands. When it's your turn, the host will call your name, activate your microphone, and ask you to unmute. And after you push the unmute button, you'll be able to give your comment. And as usual, we have a very high number of attendees today. So to make sure we maximize our ability to hear from commenters, we're going to be adhering to a 2-minute comment time limit. And there's other opportunities to connect with us beyond today's workshop. So as always, please feel free to reach out to climatedisclosure@arb.ca.gov. So we'll start the workshop with a quick review of what the 200s are and staff's progress to implement these laws to date. And then we'll talk at length about the scope of the initial regulation, which staff is planning to bring to the board in Q1 of 2026. And this initial regulation establishes a first year only 2026 scope 1 and 2 reporting deadline, as well as fee administration. Now, as part of this discussion, we'll talk about efforts CARB is making to support compliance, and we'll touch on feedback that we received on the preliminary list. We'll follow that up with a discussion on updated definitional and exemption proposals, and then we'll move into a discussion of SB 261 and the resources CARB has released to date to support compliance with the January 1, 2026 statutory deadline. And finally, we'll end with a discussion of the next steps in our rulemaking processes, and we'll then welcome feedback from the public. So with that, I'll hand the presentation over to my colleague, Dr. Paul Fermo. Paul.
Thank you, Jordan. So California has long been a leader in climate policy. AB 32 set the state's first economy-wide emissions reduction target in 2006. We not only met that goal, reducing emissions to 1990 levels by 2020, but we exceeded it, and our work continues today. CARB has a strong set of programs designed to reduce greenhouse gas emissions. Cap and Invest, which just received direction through 2045, the Low Carbon Fuel Standard, and a suite of mobile source regulations. These programs also support efforts for greenhouse gas reporting. The Mandatory Greenhouse Gas Reporting Regulation, MRR, provides emissions data for the Cap and Invest program, including Scope 1 emissions from large emitters. And the Low Carbon Fuel Standard includes Scope 1 and Scope 2 emissions reporting for fuel producers. Continuing California's climate leadership, the legislature has enacted a landmark package of corporate climate disclosure laws. These laws help advance transparency around corporate greenhouse gas emissions, including Scope 1, Scope 2, and Scope 3. Legislation authored by Senators Scott Wiener and Henry Stern established California's climate disclosure laws, SB 253, SB 261, and SB 219, which are codified in Health and Safety Code 38532 and 38533. For brevity, and because we see the implementation of these disclosure bills as complementary efforts, we collectively refer to them as the 200s. The goal of these laws is to improve transparency on corporate climate-related risk and emissions to inform consumers and investors in California. This slide provides a quick comparison of the major components of the statutes. And just to be clear, in several points throughout the presentation, we refer to SB 253 and SB 261 by their original bill names rather than the statutory reference in the Health and Safety Code. But when you see SB 253 and 261, just know that we are referring to the text as amended by SB 219 in 2024. Starting with SB 253, this bill applies to large public and private companies doing business in California with annual revenues over 1 billion. These are the entities that will be required to disclose their emissions across all three scopes. That means not just Scope 1 and Scope 2 emissions, which cover direct emissions and purchased energy, but also Scope 3 emissions, which include all indirect emissions upstream and downstream in a company's supply chain. Legislative requirements also outline several key deadlines. The first reporting year for Scope 1 and Scope 2 disclosures will be 2026 for entities prior fiscal year, using best available methods, and Scope 3 reporting begins in 2027. The law also includes third-party assurance requirements, starting with limited assurance for Scope 1 and 2 in 2026, and moving toward reasonable assurance in 2030. SB 261 applies to companies doing business in California with annual revenues over 500 million. These entities must disclose their climate-related financial risks, and the first of these must be posted on their company website by January 1st, 2026. These reports are to be completed on a biennial basis. Both laws encourage alignment with existing disclosure standards, including the Greenhouse Gas Protocol for reporting under SB 253 and the Task Force on Climate-Related Financial Disclosures, or the TCFD, or the International Sustainability Standards Board, ISSB, for reporting under SB 261. The TCFD has recently merged with ISSB's International Financial Reporting Standards, the IFRS. The regulatory process to implement the 200s is underway. At the end of last year, we released an enforcement notice related to first-year implementation of SB 253, as well as an information solicitation to garner stakeholder input. In May of this year, we held the first public workshop on the 200s, followed up with an FAQ that we released in July and updated in tandem with this workshop. Staff held a subsequent workshop on key definitions and proposed concepts for the fee regulation in August. CARB has also released a series of public resources to guide stakeholders, including an SB 261 checklist, a preliminary list of regulated entities to help inform the number of entities that would be subject to the fee, along with a survey to collect feedback, and a draft Scope 1 and 2 reporting template. Staff have taken written feedback on these materials for consideration in the initial regulatory package that staff plans to propose to the board in Q1 of 2026. Now, with that segue, let's discuss the scope of the initial regulation that staff will propose to the board in Q1 of 2026. The initial regulation will establish two main themes. First, the regulation will establish a first-year only reporting deadline for SB 253. for Scope 1 and 2 emissions. This deadline will only apply for the first year of reporting in 2026. Second, the initial regulation will establish the administration fee, including the methodology for calculating, administering, and enforcing the fee. Let's discuss the first component of the initial regulation, establishment of the 2026 first year only Scope 1 and 2 reporting deadline under SB 253. Staff reviewed public feedback on the original proposed reporting deadline of June 30th, 2026. Most comments submitted to CARB advocated for a later reporting date that allows for more time for data collection and processing. As a result, staff is now proposing a first year only Scope 1 and Scope 2 emissions reporting deadline of August 10th, 2026, aligning with the verification deadline under CARB's mandatory greenhouse gas reporting regulation. Staff also heard feedback that a one-size-fits-all reporting deadline may be challenging for companies to navigate depending on when their respective fiscal years end. To ensure that reporting entities have adequate time to meet the obligations set forward by SB 253, staff is proposing the following schedule to determine which fiscal year data shall be used by the reporting entities. So within calendar year 2026, if the reporting entity's fiscal year ends between January 1st and February 1st, 2026, the entity will report data from the fiscal year ending in 2026. If the reporting entity's fiscal year ends between February 2nd and December 31st, 2026, the entity will report data from the fiscal year ending in 2025. Under this schedule, each entity will have at least 6 months after the end of their fiscal year to submit their greenhouse gas report and assurance report. Staff are proposing this flexibility based on feedback we received after the August workshop. The Air Board appreciates the challenges of setting up a new program, and staff are invested in supporting stakeholders with compliance as we get the corporate disclosures program off the ground. So to help stakeholders transition into reporting, in December 2024, CARB announced that it will exercise its enforcement discretion for good faith first year submissions to support entities actively working toward full compliance. We've received several questions about how this enforcement discretion will be applied for first year SB 253 reporting and wanted to provide some clarity regarding this topic. So first, we want to reiterate that for the first reporting cycle in 2026, reporting entities may submit Scope 1 and Scope 2 emissions from their prior fiscal year that they already possess or were already collecting at the time the notice was issued, including data submitted through voluntary or separate regulatory programs. In other words, for the first year's SB 253 reporting in 2026, no new information is required. CARB is not asking that companies do anything different from what they were already collecting or compiling. CARB is not requiring new data collection for 2026, but entities are expected to provide any Scope 1 and 2 information they already have. Use of the draft Scope 1 and 2 template is also optional for 2026 reporting. And if a company develops its own annual report that includes information on Scope 1 and 2 emissions, that company may submit that report to CARB, and this will meet the requirements for 2026. If an entity was not collecting data or was not planning to collect data at the time of the time that the enforcement notice was issued, they will not be expected to submit Scope 1 and 2 reporting data for the first reporting cycle. Instead, a company in this situation should submit a statement on company letterhead to CARB stating that they did not submit a report and indicating that in accordance with the enforcement notice, the company was not collecting data or planning to collect data at the time that the notice was issued. Consistent with the December 2024 enforcement notice and the general message of provide what you have, limited assurance is not required for data submission for the first year 2026 reporting. I'll now pass the presentation to my colleague John Chung to discuss the fee administration aspect of the initial regulation.
Thanks, Paul. I will now cover the second component of the initial regulation, the administrative fee provisions. The 200s authorize CARB to assess an annual fee for the implementation and administration of the new reporting programs. CARB has experience with implementation fees, including through our AB 32 cost of implementation, known as COI, fee regulation, which was adopted to support implementation of AB 32. Staff introduced an initial concept on the fee provisions for the 200s in the August public workshop and received feedback and reviewed feedback received on this topic after the workshop. In this section, I'll talk about the proposed fee administration provisions, and we'll touch on preliminary number of regulated entities, as well as data considerations for future administration of the fee provisions. As we presented in August workshop, the recurring annual fees will cover the cost of implementing both the SB 253 and 261 programs, which is about 13.9 million annually. The fee provisions will also include setup costs for the programs, covering the initial 20.7 million that was temporarily funded through the Greenhouse Gas Reduction Fund in recent fiscal years. Fees will also be subject to annual adjustments for inflation and deficits. Staff is still pursuing a flat fee structure to cover SB 253 and SB 261 implementation costs. A flat fee structure is simple to implement and provides certainty as to what covered entities will have to pay. A flat fee structure means that it will be the same amount for all covered entities under each reporting program. So SB 253 entities will all pay the same SB 253 related fee, and SB 261 entities will all pay the same SB 261 related fee as well. Entities covered under both regulations will pay two fees total, one for each regulation, as each of the two fees recovers CARB's costs for a different reporting program. The flat fee for each program is calculated as the total annual program cost divided by the number of covered entities. Invoices will be issued after the board adopts a regulation and the fee schedule is finalized through the rulemaking process. CARB will develop fee amounts based on the number of entities that are required to report in 2026 under SB 253 and SB 261. Each covered subsidiary is still assessed its own fee. A parent company may pay all fees in one combined payment if they choose to do so. So for example, if Company A has 3 in-scope subsidiaries, Companies B, C, and D, Company A may submit a single combined payment covering Companies A, B, C, and D. In summary, fee amounts will be determined based on how many entities are covered per program and annual cost of the program. Just to reiterate, entities that are subject to SB 261 with annual revenue of more than 500 million and less than 1 billion would annually pay only the SB 261 implementation fee. Entities that are subject to SB 253 with more than 1 billion in annual revenue would annually pay both the SB 253 implementation fee and the SB 261 implementation fee. And here we'd like to briefly discuss the preliminary list of regulated entities. At the August workshop, staff estimated the number of regulated entities using California Secretary of State data and a proprietary data set, and later released the underlying list of entities itself. This preliminary list was intended to provide an estimate of total entities subject to the 200s in order to support development of the fee calculation. The list is not a compliance tool, and each entity meeting reporting applicability provisions remains responsible for compliance. Staff recognized a number of issues with the list and appreciated the feedback provided by stakeholders. The main challenges with the existing data sources staff relied upon include entities missing from lists that should have been included, questions about the accuracy of revenue estimates from proprietary datasets, large number of duplicative entries, and outdated information owing to data gaps in the source list of companies registered to do business in California. Staff acknowledged the limitations of relying on proprietary datasets and publicly available data sources for estimating revenue and assessing fees for covered and reporting entities. CARB must project the number of entities subject to the 200s on an annual basis for fee purposes, including revenue and doing business. As demonstrated, publicly available data sources are insufficient for verifiable year-to-year assessments, creating potential implementation challenges. Staff relied on data from the California Secretary of State for the list of entities registered to do business in California and identify several issues with this data. Based on stakeholder feedback and CARB's efforts in identifying potential data sets for identifying regulated entities, staff recommend that the most reliable, efficient, and enforceable data for implementing the 200s would be a subset of corporate tax filing from the Franchise Tax Board. Entities filing with FTB will have necessary information to determine whether they meet revenue and doing business definitions proposed by staff in next section. For example, Form 100 data for corporate filers and Schedule R data for corporate group filings would help CARB more precisely identify which businesses are subject to the regulations based on revenue and doing business thresholds. To operationalize this, staff could evaluate revenue thresholds based on Schedule F, line 1A in the Form 100, or Schedule R1, column A. And for group filings, any subsidiary or company listed on Schedule R could be considered as doing business in California unless they could demonstrate they're not meeting FTB's sales threshold definition. California sales reported by each entity in Schedule R1, column B would also help staff make this determination. Staff will discuss these proposed definitions in more detail in the next section, and any future data sharing would occur under strict confidentiality and statutory authorization. Until the FTB pathway is finalized, CARB will continue to rely on the preliminary list and voluntary surveys for stakeholder input to help project the number of entities subject to the requirements of the 200s. As previously stated, the purpose of this list is not to advise entities on compliance obligations, and as with many of CARB's other regulations, entities should consult staff's proposed definitions and exemptions criteria to determine their compliance obligation, which staff will present now. This information is also included in the updated FAQ staff posted yesterday. With that, I'll now hand the presentation to my colleague, Salvador Grover.
Thanks, John. In this next section of the presentation, I will present staff's updated proposal for definitions of key terms for applicability of the 200s, as well as proposed exemptions. So starting with revenue, based on multiple iterations of feedback received, staff are proposing a definition of revenue to match the California Franchise Tax Board's definition of gross receipts, as defined in the California Revenue and Taxation Code, Section 25120, Subdivision F, Paragraph 2. This definition was originally proposed in the May workshop, but was reconsidered and was discussed again in the August workshop after receiving mixed public comment. However, after additional public comment and review, staff have determined that this definition can be verified through FTB tax filings and provides a clear, unambiguous revenue number for entities to reference, which is not available with alternative definitions. To account for annual changes in revenue, staff are proposing that applicability would be determined by the lesser of the entity's 2 previous fiscal years of revenue. This approach gives an additional flexibility to entities and prevents the seesaw effect of companies dipping in and out of coverage on an annual basis. Moving on to doing business in California. After reviewing the public feedback we have received, staff are refining the definition of doing business in California that was proposed during the August public workshop. Staff are proposing to use the definition from Revenue and Tax Code Section 23101 to determine doing business in California for both SB 253 and SB 261. However, staff are proposing to omit sections 23101 subdivision B paragraphs 3 and 4, which relate to property holdings and payroll. This definition ensures that to become subject to the regulations reporting requirements, entities have a significant economic nexus within the state of California. This definition is also responsive to public feedback stating that the income and property value of roughly $73,000 was too low of a bar for the purposes of the 200s. We've included the text from the Revenue and Taxation Code itself here for your reference. Moving on to the identification and treatment of subsidiaries and their parent companies as covered under the 200s. We have received many questions about parent-subsidiary relationships since the August workshop. Staff are proposing to use the definition of corporate association based on existing practice in the Cap and Invest regulation, which are listed on the next slide. This definition is used to determine if a parent company can submit a consolidated report to meet the reporting requirements of a subsidiary. If two companies do not meet any of these criteria of corporate association, then they must each submit separate reports. This definition does not influence the definition of revenue or doing business, and each entity is evaluated individually to determine if they meet the statutory thresholds. I'll now pass the presentation on to my colleague, Mason Eastman, to continue discussing definitions.
Thank you, Salvador. A corporate association exists when one entity has an ownership interest in or control over a second entity. This slide lists the situations that determine ownership or control. A direct corporate association also exists when two entities are connected through a line of more than one direct corporate association. Harmonizing with the Cap and Invest regulation continues existing CARB practice while allowing significant flexibility for covered entities. Here's one common question we've received about parent-subsidiary relationships and reporting. If a US-based parent entity has a subsidiary doing business in California, is that US-based parent entity automatically deemed to be doing business in California? The answer is, inclusion criteria should be assessed on an individual company basis. This is true across the board. If a company meets the inclusion criteria thresholds, then it's subject to the applicable requirements of HSC sections 38532 and/or 38533. Both a subsidiary and the US-based parent company assess their own compliance obligations based on the criteria outlined in statute and the proposed definitions provided. Staff developed flowcharts to help entities determine whether they have disclosure requirements under the 200s. Using SB 253 as an example, an entity would evaluate whether they are covered by stepping through this diagram. Start by considering if you're a US-based company. If yes, check the list of proposed exemptions and exclusions. If not exempted or excluded, evaluate whether you are doing business in California as defined by staff's proposal. Then evaluate whether you meet the $1 billion revenue threshold. If you do, then consider if you have a parent company that will report on behalf of you. If not, then you report for yourself using one of the organizational boundaries in the Greenhouse Gas Protocol. If a parent company will report on your behalf, then they can include you in their consolidated SB 253 report. Staff also developed a similar flowchart for SB 261, which you can use as a reference. These flowcharts are also included in our updated FAQ document available on our website. Staff received significant feedback regarding coverage of the 200s and whether certain categories of organizations should be exempted. This slide covers proposed exemptions for the 200s, as well as types of entities that the statute excludes and do not need to be exempted. Staff are proposing the following exemptions from coverage under the fee provisions, SB 253 and SB 261. Nonprofit or charitable organizations, defined as tax exempt under the Internal Revenue Code. This includes the California Independent System Operator, or CAISO, as well as nonprofit universities. Companies whose only business in California is the presence of teleworking employees are also proposed to be exempted. The following entities are excluded by statute, either explicitly or by virtue of the definitions of covered and reported entities, and do not need to be exempted in the initial regulation. Federal, state, and local government entities, and CARB is also proposing to interpret this as including companies that are majority owned by government entities, meaning greater than 50% ownership, and business entities that are subject to regulation by the Department of Insurance in the state, or are in the business of insurance in any other state. This language is explicit in SB 261, and staff is proposing to extend that exclusion to SB 253. In addition, though not listed here, certain financial institutions, such as holding companies and mutual funds, would be excluded by virtue of the definition of revenue staff are proposing, as they generally do not report gross receipts in their corporate taxes. Staff have provided this additional clarity on proposed definitions and regulatory concepts so that entities have all the information they need to determine whether they are in scope of the initial regulation and the 200s in general. CARB's preliminary list of regulated entities should only be viewed as a tool for helping determine approximate annual fees. This list is not a compliance tool. Instead, companies should closely review the proposed definitions in light of their organizational structure and FTB tax filings. It's the responsibility of each business entity to review the updated proposed definitions and exemptions to determine their obligations under the 200s. And again, I want to stress that CARB is focused on supporting compliance, as is our practice across all of our programs. With that, I'll pass the presentation to my colleague Leo Ray to continue the presentation.
Thank you, Mason. In this part of the presentation, I will provide updates and further guidance on climate-related financial risk reports pursuant to SB 261. As a reminder, per direction from the statute, SB 261 first reports are due on January 1st, 2026, and must be posted on the company's website. The extended timeline for consideration of the initial regulation does not impact the first-year reporting deadline for SB 261, because that deadline is written in statute. In December 2025, which is 1 month before the first reporting deadline, CARB will open a public docket for cover entities to post the location of the public link to their report. Reports must be posted on the company website by the statutory reporting deadline of January 1st, 2026, and the link to that report must be submitted to the CARB docket by July 1st, 2026. To support compliance with the first year 261 deadline, staff posted a detailed 261 reporting checklist on our website after the August workshop. This checklist tracks SB 261's reporting requirements and deadlines, and is intended to help companies that may be newer to developing climate-related financial risk reports. It serves to describe the minimum components that must be included in a climate-related financial risk report. Staff posted an updated version of this checklist yesterday with a few targeted edits that should provide more clarity to cover entities. Entities in the early stages of evaluating climate-related risks may begin by disclosing how these risks relate or may be relevant, even if no material risks have yet been identified or no actions have been taken. Cover entities may include in their disclosures descriptions of gaps, limitations, and assumptions made as part of the assessment of climate-related issues. Under SB 261, the legislation identifies 3 options for entities to use in developing their climate-related financial risk reports. The first option is the final report of recommendation of the Task Force on Climate-Related Financial Disclosure, also known as the TCFD 2017, or its subsequent iterations. The second option is the International Financial Reporting Standards, or IFRS, which is a set of global accounting standards. And lastly, a framework developed in accordance with any regulated exchange, national government, or other government entity. Each climate-related financial risk report submitted to CARB should do the following. It should contain a statement on which reporting framework is being applied. It should discuss which recommendations and disclosures have been compiled and which have not. And it should also provide a short summary of the reasons why recommendations/disclosures have not been included, as well as discussion of any plans for future disclosures. 4 main principles underpin the climate-related risk disclosures informed by TCFD and the IFRS disclosure standards. They are governance, strategy, risk management, and matrix and targets. Each of these is described in detail in the 261 checklist, which aligns closely with TCFD 2017 and is also informed by IFRS S2. We do not expect companies to be developing new data or methods to comply with this first reporting period. As previously stated, provide what you have. We will pivot now to next steps. Looking ahead, several deadlines are coming up in the year of 2026. As we just discussed, by January 1st, cover entities must make available to the public on their own website a copy of the first SB 261 report. CARB will open a public docket to collect website links starting December 1st, 2025. In Q1 of 2026, staff will present the initial regulation to the CARB board for consideration. Staff plans to propose to the board as part of the initial regulation that on August 10th, the proposed 2026 SB 253 Scope 1 and Scope 2 reports will be due. Staff also plans to propose to the board that on September 10th, CARB will assess fees for covered and reporting entities and send invoices to the covered parties. We discussed the scope of the initial rulemaking at length earlier in this presentation, which will include the first year only 253 emission reporting deadline and the fee administration provisions. However, shortly after presenting the initial regulation to the board, staff will initiate a subsequent rulemaking for SB 253 to establish other program requirements, which include data assurance requirements, further enforcement provisions, a recurring reporting deadline beyond 2026, and a reporting template incorporating public feedback. We also want to appreciate the constructive feedback that staff received on Scope 1 and Scope 2 emissions reporting draft templates. We received more than 100 public comments from businesses, trade associations, individuals, and NGOs. Some of the main topics were requests for organizational boundary flexibility, emissions intensity disclosures, assurance, emission reduction initiatives, gas versus source disclosures, and Scope 2 emission reporting procedure. CARB is reviewing and evaluating stakeholder feedback to inform future drafts. As a reminder, entities are not required to use the draft Scope 1 and Scope 2 emissions reporting template for the first year report in 2026. And although the 2026 reporting deadline only includes Scope 1 and Scope 2 emissions, staff continue to look ahead to Scope 3 emissions. As required in the statute, CARB expects to require Scope 3 emissions reporting as part of SB 253 reports starting in 2027. Scope 3 reporting includes 15 categories of emissions according to the GHG protocol. 8 of them are upstream emissions and 7 are downstream emissions. Staff invites feedback on which of the 15 Scope 3 categories are most utilized by companies today and/or most helpful for investors and consumers, and which categories should be prioritized for program development. Questions and suggestions can be emailed to climatedisclosure@arb.ca.gov. With that, we have completed the staff presentation. We'll now move to the public comment portion of the workshop. I will hand the presentation to my colleague, Emily Gehagen, to oversee the public comments.
Thank you, Leo. If you would like to ask a question or provide a brief comment, please use the raise hand function on your Zoom screen. Staff will aim to call on attendees in the order they raise their hands on Zoom. Zoom phone participants may dial number 2 to raise your hand. When it's your turn, I will call your name, activate your microphone, and ask you to unmute. After you push the unmute button, you will be able to give your comment. If you're joining on the phone, you can dial *6 to mute or unmute. Our first comment is from Dong-Young Kim. I have activated your mic. Please unmute yourself and begin your comment.
Hi, thank you First of all, thank you for the helpful workshop today. I have two questions. First, regarding the revenue threshold for the 200s, as the revenues are defined under the tax code, do the revenues of subsidiaries count towards calculating the revenue of their parent company? And my second question is, once it's determined that a company is a reporting entity subject to the 200s, does it have to report only on itself or also on its subsidiaries, assuming that none of the subsidiaries are covered entities? And if they do need to report on subsidiaries, do the definition of subsidiaries follow the definition that was discussed today that is set to be used for the cap and trade program?
I can answer that first part regarding whether the revenue of the subsidiaries is calculated as the revenue of a parent company. And the answer to that is it depends on the tax filing. So when a company and its parent company and its affiliated subsidiaries file as a unitary filing under the FTB, then in that case, yes, the calculations, the revenue of the subsidiaries would count towards the calculations of the revenue towards the parent companies. If they file separately under the FTB, then they would be separate.
Thank you.
And
And can
happy to
someone else?
Yeah, happy to take the second question. So Sydney Burgess, Assistant Division Chief at CARB. I believe you were asking about the reporting relationships. So every company, whether it be a subsidiary or a parent company, should confirm that they fall under the criteria established by either SB 253 or SB 261, as modified by SB 219. So that criteria is it a US-based company? Is it doing business in California? And does it meet the revenue thresholds? If the answer to that is yes, in this case for the parent company, if the answer is yes to all three, then yes, they would need to report on their own activities as well. If the parent company is out of scope, I would say that a reminder is that the parent company has the option to report on behalf of its subsidiaries. Thank you.
Thank you for your comment. Our next comment is from Michelle S. I have activated your mic. Please unmute yourself and begin your comment, and please say your name and affiliation.
Hi, sorry for the Michelle S. It's Michelle Savage. I'm with XBRL US, and I have two questions. To satisfy SB 253, I understand the companies can input data to a spreadsheet that CARB has provided. CARB could format this spreadsheet so that it produces digital machine-readable data that can be consumed automatically. My organization, we're a nonprofit. We created a similar template in Excel that any company could use to input their emissions data, upload it to an application, and generate fully automated machine-readable data that's in XBRL format, which is a widely known open data source, open data standard. The tool that we created is open source, so it's completely free, and there will be no cost for CARB to just adapt this to their own purposes and make any adjustments that you see fit. And if you were to collect the data in digital machine-readable format rather than just in Excel, the data generated would be a lot cheaper to manage, to process and analyze, both for CARB, but also for other data users. And it would also be less expensive for CARB to collect and make this data available to the public. It would reduce the cost of the entire program, both for year one and years going forward. And that, in turn, could potentially reduce the administration fees that companies have to pay. So is this something that CARB is considering for the rule? So that's question one. Question two, you've also indicated that CARB will accept reports that are submitted to others. So a company prepares a report that they need to submit to a regulator in a non-US market or to an investor. That report can be repurposed and sent to CARB. Many of those reports are being created in XBRL format as well for CSRD and for IFRS countries. If you accept those reports that are also in XBRL format, will you be using the XBRL data from those reports, or will you just be manually extracting the data? So thank you very much.
Hi, Michelle. This is Jordan. Thanks for your comment. Just to quickly answer your questions, we're going to be looking into and developing the reporting format in detail in the subsequent rulemaking after the Q1 board hearing, and we've proposed our initial rulemaking in Q1. And so we'll be digging into the reporting format a lot more in 2026 as we develop that subsequent rulemaking focused more on SB 253. Thank you.
Thank you for your comment, Michelle. Our next comment is from Jonathan Kendrick. I have activated your mic. Please unmute yourself and say your name and affiliation and begin your comment.
Good morning. This is John Kendrick from the California Chamber of Commerce. Really appreciate the presentation today. I think this is a positive step forward on several fronts. The approach on the scope 1 and scope 2 reporting in the first year would alleviate a lot of our concern on that issue. Definitely still have a lot of concerns though about the approach taken in the scope 1 and scope 2 template, pushing California in the direction of a California specific standard that's contrary to the statutory language that authorizes this. Anything where you're mandating a single GWP value or a single organizational boundary means that you would be reporting different numbers in different jurisdictions. That's incredibly problematic from a clarity perspective. We do believe that there needs to be a safe harbor on 261 reporting. You still have not defined the universe of who needs to report on January 1st in a binding way. The definition has changed multiple times. There should be a safe harbor once the definition is finalized to have a period of time to make your report. Would definitely like additional clarity on the information being reported, what will be public versus confidential. Some fields under consideration, such as an emissions intensity by revenue, could reveal highly sensitive financial information for privately held companies. So we need a clear designation of what elements are public facing and what are protected. We encourage CARB not to use a third-party emissions reporting organization for data collection. That's just a central repository for industrial espionage, national security concerns. Do have a quick question as well. What is the timing for release of the regulatory package? Is it going to be released in Q1 or is it going to be released Q4 this year? Thank you.
Hi, Jonathan. With regard to the timing question, there's the board hearing will be in Q1, and then we will release it in time for there to have been 45 days for public comment per the APA, and then we'll be able to present it to the board. So stay tuned for the posting.
Thank you for your comments. Our next comment is from Kevin Heed. I have unmuted your mic. Please say your name and affiliation and begin your comment.
Hi. Yes. Can you confirm you can hear me?
Yes.
Okay, great. Thank you. This is Kevin Head. I'm with the California Independent System Operator. I had a question about the proposed exemptions that are in today's slide deck. In the workshop that was held in August, the slides included a potential proposed exemption for business entities whose only activity within California consists of wholesale electricity transactions that occur in interstate commerce. And that exemption would effectively give effect to the legislative intent expressed by some of the bill authors of SB 253 and SB 261 that was submitted into the California State Senate daily file around the time of the passage of the legislation. I noticed that the slide deck for today's workshop does not include that exemption. So I had a two-part question here. One, was it an intentional decision to remove that exemption? And second, if it was an intentional decision, can you explain what the rationale was for removing that exemption? Thanks.
Hi, Kevin. Thank you for the question. I just want to reiterate that CAISO, the California Independent System Operator, would be excluded or exempted based on what we're proposing here. We had talked about nonprofits being exempted or tax-exempt entities being exempted from the 200s, and I believe CAISO is listed as a nonprofit, and so they would not be subject to reporting requirements. Thank you.
Thank you. Our next comment is from Jeff Hicks. Please unmute yourself, say your name and affiliation, and begin your comment.
Thank you. I want to echo the appreciation for today's workshop that others have expressed as well. My name is Jeff Hicks. I'm with ISS Corporate. Our corporate sustainability division develops targeted sustainability strategies that inform stakeholders and also attract capital. My question is on the administration of SB 261 and the reasoning for opening the public docket December 1st and leaving it open until it closes July 1st, while the legislation requires the disclosures to be published January 1st. By leaving the docket open, the impression and often the questions we get from our clients is there an assumption here that disclosures can be amended or improved through the first half of 2026? Is it waiting until then for the enforcement? Does that give maybe a secondary deadline? And a lot of this is from clients that, especially those that have either waited too long or are in the kind of throes of other priorities that have sort of kept them from being able to address this. So the idea is, can we put up something January 1st that maybe checks the box and then amend and improve that to be more closely aligned with TCFD or IFRS 2? Any illumination you can give with regard to why that public docket is being left open for 7 months or 6 months after would be very helpful in the advice that we're giving our clients. Thank you very much.
Thanks for the question, Jeff. This is one of my favorites. This is one of the attempts we've made here is to really try to make sure everyone has an equal opportunity to come into compliance, in this first year. So statute says post on your website by January 1st. That should be your report. We are trying to be nice because it did not seem like quite fair to have a docket open for, say, 24 hours right on New Year's to collect all the website links from everyone posting on their website. So if folks are ahead of the game and post to their website early and want to let us know where their report lives on their website as early as December 1, that's great. If folks don't get around to telling us where exactly it's been posted until later, that's fine too. Again, we're trying not to be overly onerous about getting back to us. I usually when I provide that explanation, I don't hear calls for shortening the public docket period. Folks seem to appreciate that they have ample time to let us know where the report lives. So when you're advising your clients, please share that this is our attempt to try to make for a streamlined onboarding into the program. Thanks.
Thank you. Our next comment is from Andrews Verschelden. I have unmuted your mic. Please share your name and affiliation and begin your comment. If you're speaking, we cannot hear you.
Can you hear me now?
Yes.
Thank you for the continued guidance that CARB has provided throughout this process. My name is Andres Verschelden, and I lead Good Lab. We're a climate advisory and software firm, and we're supporting companies that are preparing for compliance with this new climate disclosure requirement. The updated FAQ, and specifically question 3 there, states that the deadlines are not affected by the initial rulemaking being delayed to Q1 2026. Based on the workshop materials and the FAQ, our understanding is that at least some of the timelines are new. We would appreciate confirmation of these changes. Specifically, what we heard for 253, for the first year Scope 1 and Scope 2 reporting deadline, CARB is proposing August 10, 2026 now. We also understand that limited assurance is no longer required for the 2026 submission. And then finally, entities that are not collecting Scope 1 and 2 data at the time of the December 2024 enforcement notice may submit a written statement instead of data for the first year. And then my second question is if you could confirm that the assurance expectations for 2027 will hold. So in other words, will companies be expected to obtain limited assurance on their SB 253 reports for the 2027 reporting cycle? Thank you so much.
Good morning. Yes, thank you for the questions. Okay, so make sure I cover all of those. So first you asked about the updated proposed timeline for first year only 2026 Scope 1 and 2 emissions reporting. So yes, in response to public feedback, we pushed that back from the originally proposed June 30th from the August workshop to August 10th. August 10th is also the verification deadline under the mandatory greenhouse gas reporting regulation for CARB. And so given that there's a number of entities that may be covered under both programs, we thought it would be a nice streamlining option to align the reporting deadlines there. But I hope you caught in the slides as well, we included basically a threshold of, I believe it was February 1st, where based on when your fiscal year ends, you would report either the most recent prior fiscal year or the fiscal year before. And so what that effectively does is give at least 6 months of time between the end of the fiscal year and the reporting deadline to compile data. And at least 6 months, which we heard in the feedback from stakeholders after the last workshop, that would be helpful. And for some entities, it would be much more. So we hope that that's really helpful for reporting entities. You asked about limited assurance in 2026. That is correct that per the enforcement notice that we put out in December 2024, essentially what we're saying is give us what you have, what you already were planning to collect or were collecting at the time the enforcement notice was released. So effectively, if you have data on Scope 1 and 2 that is already assured at this limited assurance level, great. Turn that in at the deadline. If you do not have it, then that data you have data, but it's not assured. You can turn in that data for 2026. That is okay. You asked about assurance expectations for 2027 and onward. So the enforcement notice only applies to this first year's reporting in 2026. And so the expectation would be, per statute, that limited assurance moving forward in 2027 and onward would be required. And again, we'll be following up with a subsequent rulemaking later in 2026 after the Q1 board hearing for this initial regulation. That's going to dig into the details on 253 reporting, and that's really going to focus on 2027 plus, right? 2027 and subsequent years. Thank you.
Thank you for your comment. Our next commenter is Joseph Riccio. I've unmuted you. Please share your name and affiliation and begin your comment.
Hello, Joseph Riccio, Mitsubishi Corporation Americas. Thank you very much for this presentation. Very impressive material. I just wanted to make one comment. I think on slide 34, it was saying the docket is going to be December 2026, which I found a little confusing. So I just wanted to make a note of that in case it needs to be corrected. Thank you very much.
So much. Thanks so much. Really appreciate that. Always great to have OEM join us. In terms of the December docket, as you are aware for the SB 261 reports, those will need to be posted on your own website by Jan 1. So then the question becomes, how do we as companies let CARB know where those reports are posted? Well, if you're ahead of the game and you want to let us know where those reports are posted, because you're A+ students, which I know you to be, Joseph, then you can let us know as early as December 1st, or if it takes you a little while after the new year to let us know, that's okay. We're trying to allow for a gracious period of onboarding into this program. But if you want to let us know on January 1, you're feeling good, it's been posted to your website and you want to let us know, like first day of the new year, the doc will be open for you then too. Thanks so much.
Thank you for your comment. Our next comment is going to be from Brian Beering. I've unmuted your mic. Please share your name and affiliation and begin your comment.
Morning, this is Brian Beering with the American Clean Power Association of California. I wanted to follow up on the comment you got from the CAISO regarding slide 31. We had a similar question around whether there was going to be an exemption consistent with the legislative intent of of SB 253. We had included a link to that letter in our comments as well. And the issue there is not just that the CAISO itself as a nonprofit be exempt, it's also the entities that are participating in the enhanced day-ahead market, as well as the Western Energy Imbalance market. We are at a time when we're trying to encourage as much participation as possible in those markets, and they are regional markets. It's not just California. So we really are hoping to see something in the rulemaking package that clarifies that an entity whose only business in California is through participation in this broader regional market would be exempt from the reporting and disclosure requirements. Thank you.
Thank you for your comment. Our next comment is from Shunzhang Wang. I have activated your mic. Please share your name, affiliation, and begin your comment.
Thank you so much. This is Sean Sheen at Cleary Gottlieb Steen in Hamilton. I have 4 questions. I hope I can get through those in 2 minutes. I appreciate you all taking the time today. First question, just to confirm my understanding, assuming the revenue thresholds are satisfied, it sounds like what you were saying before is that each company can rely on whether they file with FTB as a marker for whether they're doing business in California. Just wanted to make sure that I was understanding that correctly. Second, as a technical clarification, if a parent is not a covered entity, but a subsidiary is a covered entity, should the parent submit the parent level company information on behalf of the subsidiary, or can the subsidiary submit the parent information report itself? And then last 2 questions. One on fees. Are the fees should those be paid on the same deadlines? So for 253, payment by August 10th. For 261, should that be Jan 1st or July 1st to match the submission to the docket? And then my 4th question, in terms of those same dates, is the idea that going forward, 261 reports would have the Jan 1 deadline and 253 reports would have the August 10th deadline, or will there be different dates in future years? Thank you so much again. I appreciate you taking the time.
Hi, regarding the first question of whether companies can rely on FTB datasets for doing business, the answer is yes, but each entity will have to look at that specific filings to see what their sales within California were. So the proposed or the definition that staff will propose relies on the FTB definition of doing business, but only including the sales portion of that, which for 2024 was set to $735,000. So each entity can then look at that number on their tax filings to determine if they meet that threshold. And regarding your second question, yes, parent companies can submit on behalf of subsidiaries per the statute. And can someone else jump in for the last 2 questions?
Yeah, I can take the questions regarding the fees. So the fee invoices will be issued after the board adopts the regulation, and the fee schedule will be finalized through the rulemaking process. So we will develop the fee amounts based on the number of entities that are required to report in 2026 under both SB 253 and SB 261.
And I think there was a question about the reporting deadlines under 261 and 253. Just to reiterate, the statute, 261 statute sets January 1st as the recurring deadline biennially. It's every 2 years. So you can expect that that would be continued in the future. For 253, this initial regulation focuses on the first year, 2026, scope 1 and 2 reporting deadline, which we're proposing for August 10th. Subsequent reporting deadlines in future years, so 2027 plus, would be established by subsequent rulemaking focused on SB 253. Thanks.
Thank you for your comment. Our next commenter is Greg Walsh. I've activated your mic. Please share your name, affiliation, and begin your comment.
Hi, my name is Greg Walsh. I'm with HAI. I'm hoping for some clarity on a bullet point from the slide supporting SB 253 compliance. A couple other people have already touched on this, but the line entities that were not collecting data or were not planning to collect data at the time the enforcement notice was issued are not expected to submit Scope 1 reporting data in 2026. Does that mean private companies that otherwise were not capturing data are effectively exempt? And related on, if that's the case, on what authority is CARB allowing that exemption or optional reporting? I don't recall seeing it in the statute. Thank you so much.
Greg, I would point you back to our enforcement notice that we issued in December. CARB is the implementing agency here. No, private companies are not quote unquote exempt. That has a specific meaning for us in a regulatory realm. What we are asking for is if you are an entity who is not collecting data or planning to collect data at the time the enforcement notice was issued, to submit that information. And we had some information on what exactly to submit to us in our slides. So I'd refer folks to that as well.
Thank you. Our next comment is from Jason Fox. Please share your name, affiliation, and begin your comment.
Hi, good morning. Jason Fox with the California Society of Certified Public Accountants. And I believe this was addressed a few questions ago or comments ago, but I just want to kind of acknowledge it. On slide 12, there's a bullet point about 2026 reporting not requiring limited assurance. I just want to clarify that that is true, and that's the CARB exercising the enforcement authority there. A second piece to that, if a reporting entity does have assurance, they're not required necessarily to submit it, but I guess encourage or voluntarily they could submit that to CARB in that first year. Is that your understanding of how you anticipate that going for the first year?
Hey, Jason. Yes. So to reiterate, again, per the enforcement notice, we're effectively saying, give us what you have already. And so if a company has limited assurance data that they would like to submit, they are welcome to do that and be A+ students. If you do not have that information or we're not planning to collect it at the time of the enforcement notice, then it is not required for just this first year, 2026, first year scope 1 and 2 reporting deadline. If you were already collecting it, then you do have to submit it.
Thank you. Our next comment is from Alexander Davis. You are now unmuted. Please share your name, affiliation, and begin your comment.
Hi, my name is Alex Davis with Wakefront Food Corporation over on the East Coast. With respect to the definition of doing business in California, it looked like on one side you were removing the nexus definitions around having employees or real estate. So I just want to confirm, for our standpoint, our only threshold is having a teleworking employee whose income meets the nexus threshold. We don't have enough sales or any real property in California to otherwise qualify. So if that was our only footprint, so to speak, does that mean that we would no longer be considered doing business in for the purpose of these regulations? Thank you.
Hi, Alexander. Yeah, under the current proposed or the definition that will be proposed to the board, if your business, the only business you have been doing in California is from teleworking employees, then your assumption is correct that under our definition, you would not have to report. Under the proposed definition, we're only pulling the sales portion definition of doing business in California from the FTB.
Thank you. Our next commenter is Kyle Schmidt. I've activated your mic. Please share your name, affiliation, and begin your comment.
Thank you. Kyle Schmidt with the Wine Group. Two questions of clarity from the presentation. One, I apologize, has been touched on many times, going back to indicating not needing the limited assurance based on the enforcement bulletin. There was a comment today about requesting a letter stating that a company had not collected or had not begun collecting data. Is that still expected for anybody who submits and does not include limited assurance information? And then the second item for clarity, when discussing the thresholds used from the Franchise Tax Board, there was a comment about looking at the two most recent annual submittals and taking the lower of those. And I just want to confirm my understanding if the two most recent revenue submittals by the organization, one indicates that a company would be above a reporting threshold, but one indicates they are below, then the expectation is they would not have to report. Is that correct? Thank you.
Kyle, I can take the first question, and then maybe one of my colleagues can take the second one. So I think you were referring to the statement on slide 12, where we had said if a company was not collecting data or was not planning to collect data at the time the enforcement notice was issued, what should they do? And we had talked about entities submitting a statement on company letterhead to CARB saying that they did not submit a report. That did not specifically apply to the limited assurance aspect. And so my read there would be if someone is turning in scope 1 and 2 data, but does not have the limited assurance on that data, they don't need to submit a separate letter stating that. One of my colleagues can jump in and take the second question.
Did take it. I believe the question was about how to determine eligibility based on our proposal for how to determine revenue, where we said look at the prior 2 years and look at the lesser, the 2 years. For that, I believe that's in the slide deck. That's on slide 23. So I'd refer you to that as well. Thank you.
Thank you. Our next commenter is Michael Gillette. I've activated your mic. Please unmute yourself, share your name and affiliation, and begin your comment.
Hi, everyone. Thank you for taking my call. This is Mike Gillette of the American Bankers Association. On page 23 on the definition of revenue, I wanted to make sure, well, I have a couple of comments and then I have a question. So the first one on the on revenue, you had mentioned before about Dun & Bradstreet, how Moody's does things from the last webinar. They analyze bank income based on a net interest income plus non-interest income basis. They do not use gross interest income. The investor public does that. And I think most important, the banking regulators do that. And they even evaluate management based on a net interest income basis. And it's even done for safety and soundness purposes. So we actually believe that there should be a regulated bank separate process that refers to the net interest income, a different formula, in fact, because of their regulated status. So if you don't go into that direction, I think that you need to point out, whether, or at least consider legislative intent that community banks be within the scope of SB 253 and 261, because there's going to be a lot of surprises. I think you're going to need provide a safe harbor that first year, because many community banks are not engaged on this, and they're assuming, like anything else they do for revenue, is for on a net basis. So That's the first thing. Second thing on exempt organizations, we note that Congress is constantly trying to scope in more companies that are currently tax exempt. So, credit unions, endowments, things like that. I would focus on charity that it would cover. So, if I'm allowed to get to my question, is just on the greenhouse gas protocol updates. Currently, they're expecting to update and even have an update for scope 2. How is that going to affect the rulemaking process going forward? If you could put that into the any further guidance, that'd be appreciated.
Thank you, Michael, for the comment, and thanks for the question on the updates to the greenhouse gas protocol. We are aware that there's conversations happening around updating the Scope 2 guidance, and we are working on the rulemaking next year for SB 253, and we'll incorporate the direction from the legislation and develop a program that is right for California. So we will keep track of the updates and discussions around the Scope 2 guidance from the GHG protocol during that process. Thank you.
Thank you. Our next comment is from Stephen Grover. Please share your name, affiliation, and begin your comment.
Hi there, my name is Stephen Grover. I'm with Baker Tilly. I have two questions, I think. First, thank you all for the clarity on this. It's been super helpful. My first question is, there's, in this case, two companies who fall within the thresholds of SB 253 and 261. If Company A merged with Company B in the middle of 2025, and Company A will no longer have a website by July 2026, how should they link their climate risk disclosures for SB 261? My second question is, if a company will no longer legally exist by the SB 253 August 2026 reporting deadline, will it need to comply with the regulation? Thank you.
Thank you for the question. Really appreciate it. Would recommend using our definitions and guidance documents and connect with your internal legal folks to consider whether or not this particular company in particular situation is in or out. As you can imagine, there's probably a lot of specifics like this, but we're unable to advise on the specific questions. And I'll just reinforce that each company really needs to determine eligibility for themselves, similar to the way other CARP programs are implemented.
Thank you. Our next comment is from Allison Diamond. I've activated your mic. Please share your name, affiliation, and begin your comment.
Hi. Thank you for this webinar. It's really helpful. I'm Allie Diamond. I'm with Anthesis, a sustainability consulting firm. I noted that you have said that you will have more rulemaking guidance for SB 253 initially on the deadline, but you did say that there would probably be additional rulemaking and clarity given on the requirements for SB 253 in a separate later rulemaking process. I'm wondering, will there also be additional clarity rulemaking guidance for SB 261? And if so, do you have any thoughts on timing of when that will happen in 2026?
Hi, Allison. Thanks for the comment and the question. So for 261, there's kind of a fundamental difference there between 261 and 253. 253, the statute explicitly directs CARB to go and develop a regulation to undergo a rulemaking to implement that. SB 261 it does not require a rulemaking per se, at least on most parts of it. There is a requirement for enforcement provisions to be added through rulemaking, but that's about it. It's kind of self-executing in a sense. And so we believe we've put out the guidance that is necessary to implement 261 for covered entities to be able to comply with the statute. And I would refer you to our 261 checklist. We put that out couple months ago, but then we updated that last night when we updated our FAQs as well. With a few clarity updates in there.
Thank you. Our next comment is from Anna Saunders. Please share your name, affiliation, and begin your comment.
Good afternoon. My name is Anna Saunders with Toyota Bushiku America. In terms of your exemptions for doing business in California, I really appreciate the quite explicit explanations of the exemption of relating to property holdings and payroll. Will we receive the same sort of definition of telework employees, as remote work and telework are very similar? A clear definition may be beneficial in that aspect. And then also in regard to the exemptions in terms of telework and payroll, those both apply for SB 250 3 and SB 261. Thank you.
Anna, great to hear from a second OEM today. I'm going to start keeping track. Just kidding. Thank you so much for the comment. Yes, you're absolutely correct. If you have recommendations in terms of defining telework, please send it over to us. That would certainly need to be part of the regulatory package going to the board in Q1. Thank you.
Thank you. Our next commenter is Daniel the Wiki. I've unmuted you. Please share your name, affiliation, and begin your comment.
Yes, thank you. And thank you for CARB's continued support. My name is Dan Lewicki. I'm with Clean Harbors. My question is regarding 261, specifically, given that there was no template issued in the same way that there was for 253. My question is, if you already have a report that is conformant with 261, can you put a report together that links to an existing sustainability or other disclosure that has those elements, be it from TCFD or ISSB? So are hyperlinks and some kind of narrative reference allowed in a more or less outlined report that links to a pre-existing report? And then the second question is also regarding 261, and this was addressed earlier, I believe, by the gentleman from ISS. If an entity is looking to make a revision or amendment as they work through their annual, say, 10K process early into 2026, but they have already posted a report on their website, what is the compliance, I guess, implications or allowability to go ahead and make edits or revisions to that 261 risk report through the first half of the year? Thank you.
Hi, thank you for that comment. Just to answer the first one, yes, we have updated this on our FAQ. If you meet the minimum requirements as specified on TCFD by the statute TCFD, or if you are reporting to ISSB, yes, and meets the minimum requirement, you can submit the same link. So that's still been confirmed, already specified. This related to the second question, the statute mandates that you have to report this on your internal website by January 1st. So try to stick to that is our recommended action there. Thank you.
Thank you. Our next comment is from Marissa Dukovic. I have activated your mic. Please share your name, affiliation, and begin your comment.
Hi, thank you. This is Marissa Dukovic with Pacific Life. I had a couple points of clarity, some of which you've touched on, but wanted to expand. The first is on the assurance requirement. So I've heard no assurance requirement in 2026, and that it would follow in 27 to be limited, but I had thought there was a step up from there to reasonable. Is that expected to follow in 2028, or do we think we would continue with the limited? Additionally, has there been any change to Scope 3 or the assurance requirements around that, or is that reporting timeline still the same? The second piece is on the TCFD aligned reporting to 261. I think just to clarify that, we have been reporting a TCFD aligned report in the past. Is it okay to just submit the link to that, or do we have to rename it in any sort of way to be in compliance with 261? And the last question is just on investment companies. And I know there was a brief discussion on some additional exclusions. Are those excluded from being covered reporting entities? Thank you.
Hi, Marissa. Thank you for the comments. Okay, so going through those, I think this is the order you asked them. And then if one of my colleagues can take the fourth one, that would be great. So want to clarify again, we're not saying no assurance for 2026. We're saying give us what you have. And so if your data for scope 1 and 2 is assured, then you should submit that. If it's not assured, then you can submit your non-assured data for 2026. Starting in 2027, after our subsequent rulemaking has been completed and we've outlined the assurance requirements for 2027 and onward. All those requirements of statute hold. So it's a limited assurance. I believe it's 2027, 2028, 2029. And then starting in 2030, there's reasonable assurance for scope 1 and 2. You asked about scope 3. There's no changes to our approach with scope 3 with anything here. The statutes don't require scope 3 reporting until 2027. And that's something we'll be exploring in more detail in this subsequent rulemaking after the Q1 board hearing for the initial regulation. And then if there's anyone else that can take that last question, I didn't quite catch it, that'd be great.
Happy to. I believe the last question is, are certain types of firms required to report under 261? I think the question was specific to investment firms. I would point you to staff's proposal for the definitions for the various criteria that are established by statute. So is it a US-based business? Does it do business in California? And does it meet the revenue thresholds? Is the firm on the exemption or exclusion list or categories? Thank you.
Thank you. Our next comment is from Beth Schenk. Please share your name, affiliation, and begin your comment.
Hello, thank you. My name is Beth Schenk. I'm commenting as a private citizen, and I'm commenting about the proposed recommendation to exempt nonprofit organizations. My concern is that a nonprofit versus for-profit distinction is not meaningful when we're talking about $1 billion in revenue, which is the threshold for reporting. Companies or organizations of this size would have significant emissions, and they would also have significant capacity to report. And arguably, it's an aspect of good business practices for any type of organizational structure to be reporting their greenhouse gas emissions. So my question is, can you explain the rationale for this recommendation? Thank you.
Your comment. Thank you, Beth.
Thank you. Our next commenter is James Cobb. Please share your name, affiliation, and begin your comment.
Hi, yes, my name is James Cobb. I am a consultant at Environmental Science Associates, and we are working with companies to prepare for the CARB disclosures. Thank you for putting together this presentation and workshop today. I have two questions around the exemptions. First question is, I know that there are organizations that are explicitly excluded from SB 261. And I was curious if that exclusion will also extend to 253, specifically companies that are regulated by the California Department of Insurance. Are those companies are excluded by SB 261, but are they also excluded for 253? And then additionally, can you please confirm when the proposed definitions or exemptions will be solidified? We have some clients that are exempt or fall under the exemptions for the proposed exemptions, and we just want to make sure that those companies are prepared or do, prepare themselves to be excluded if that is the case. Thank you.
Hi, James. Thanks for your comments. Yes, I can confirm that we're proposing to really extend that that language in 261 about being regulated by the Department of Insurance to the 253 implementation as well for continuity. And with regard to when the definitions and exemptions, excuse me, will be finalized, what we recommend is that you use these moving forward to determine whether you're in scope for the 200s, and then there will be part of the official package that we're presenting to our board in Q1 of 2026. Thank you.
Thank you. Our next commenter is Matthew Rusk. Please share your name, affiliation, and begin your comment.
Hello, yes. I'm Matthew Rusk with DigiNex, helping organizations with our tools and solutions to provide sustainability reporting solutions. And my question, sorry, there was an echo there. My question is related to the leniency that, well, thank you for the workshop and the FAQs and resources that you provided. My question is on the leniency for this first year for 261, and that it's a biannual reporting mandate. Will that leniency in the first year impact if the organizations have to report in 2027 to more of the more stringent criteria, and then from that point on report every other year? Or after that first initial reporting, they won't have to meet the new stringent requirements from 2027 and on until 2028? Thank you.
Thank you so much, Matthew. Appreciate the opportunity to clarify. Yes, you're right. We are currently trying to prepare everyone who falls into the criteria established by 261 to prepare for the upcoming January 1 criteria to post their climate-related financial risk reports on their own website and then tell us where that is located. 261 reports, according to statute, need to be reported every other year. So the next report would be in 2028. And so hard to know what the future of the program holds as we're trying to bring everyone on board for year one. Thanks.
Thank you. Our next comment is from Kyra Kovac. Please share your name, affiliation, and begin your comment.
Hello, my name is Kyra Kovac from Integrated Sustainability Consultants. I have a two-part question regarding SB 261 disclosure. If an organization chooses to report on a U.S. parent company level, but there is no current website for this parent entity, can an organization develop a new website to host the report? And if so, is there guidance you can recommend regarding what organizational details the entity must also host on this website? Thank you.
So, Sid, you are going to address this. Go ahead.
Oh, no worries. Thank you so much for the question. First time I'm hearing about a company not having a website. Yes, totally fine to make a new website. Just make sure to report to us a link where that report is being hosted, and CARB will serve as clearinghouse so that consumers and investors can have one place to go to look at all these reports. Thanks.
Thank you. Our next comment is from Ashley Emery. Please share your name, affiliation, and begin your comment.
Hi, my name is Ashley Emery. I am with Tube Sued Verification Body. I have two questions regarding 253. Potential accreditation standards required to complete verifications were outlined in one of the previous webinars, but have there been any final standards lists that's been released, or is there a proposed timeline for release of those standards? And then my second question is that many companies voluntarily report using calendar year. And with this good faith effort, can the reporters use the calendar year instead of fiscal year? And then will they have to change going forward?
Hi, Ashley. Thank you for the question. As we mentioned, we are doing a rulemaking process next year for implementation of SB 253, and we'll be hashing out these questions about the standards and the assurance process during that time. So please engage with us next year as we go through that process. Thank you.
Thank you. Our next comment is from Adenike Akindoli. Please unmute yourself and state your name, affiliation, and begin your comment.
Hello, thank you, Carb, for all your efforts and the additional guidance provided. My name is Adenike. I work with the Coca-Cola Company. I have three questions. So one is on the parent subsidiary question. If the company is a registered LLC, but files a unitary tax return in California and is treated as a disregarded entity for tax purposes, would it still be subject to the fees, I guess is one, and do we need to call out specifically in the parent report that we're filing on its behalf? I'm just wondering if, for this filing, it's treated as a separate entity or if it's, because we treat it as a division.
Hi,
And
so,
then the second.
oh, sorry, go ahead.
You're muted if you're speaking.
Yeah. So the 253 template, you did mention it's not required for year one. We can disclose what we're already disclosing. But just wanted to understand Carb's thoughts as to the level of granularity that will be required going forward, in the second year when it's going to be mandatory, if we're still going to be required to disclose gas by source for scope 1 and scope 2, and as well as the intensity data. And then there was a request on the template around something called the MRR number for California facilities. If you could explain that in a little bit more detail. Thank you.
Thank you for your comment and questions. I can answer that first part. So each individual entity should be assessing by themselves if they meet the definitions of revenue doing business and are US based. That's regardless of whether these entities file as unitary or as individual with tax filings. Now, whether like an LLC, for example, is included in a unitary filing, that could contribute to the overall calculation of revenue, but that LLC on its own should still look at that tax filing to evaluate whether they're subject to these regulations. And now let's let someone else take over for the other two questions.
Yeah, I can jump in on the reporting template question. So I believe in the slides, it is indicated that for this first year, the reporting template is going to be for optional usage. So if reporting entities would find that useful, they can feel free to use that. For subsequent years, we are still taking public feedback on whether we should be releasing an updated draft, and if so, which provisions should we update it to match to better assist stakeholders in future years reporting. So even though the public docket is now closed, we still recommend you to submit your comment to the climate disclosure at arb.ca.gov email address, and we'll take that into consideration into the future. And regarding the MRR question, that is related to the mandatory reporting regulation, which is also administered by CARB. So if you are an entity under that regulation, you will have a specific ID code. If you are not, then you can choose to file not applicable for that field. And I believe all this information is also being clarified in the reporting template in the first README tab.
Thank you. Our next comment is from Daniela Arias. Please state your name, affiliation, and begin your comment.
Thank you, everybody. So I'm Daniela Arias. I am a practice leader with Crow LLP. We're a public CPA firm. We provide assurance consulting services. I specifically lead our emerging risk services. And we spend a lot of time helping companies with all aspects of sustainability, climate-related reporting, regulatory assurance, including these California rules, other global regulations as well. So I have three questions, but I want to be mindful of time here and understand, some of these might be better for maybe a later session. One is just a clarification on the parent subsidiary example, and I realize this might sound repetitive, but I do think this is an area where there's a lot of uncertainty, so it's good to be very crystal clear here. So based on the parent subsidiary example that CARB has shared today, I'm understanding that a parent company is not automatically considered to be in scope for SB 253 or 261 just because one or more of its subsidiaries meet the revenue and kind of business activity thresholds. Rather, that parent company has to independently meet that threshold criteria, look at its own attributable revenues and activity and so forth. So to clarify this, if a parent company itself exceeds the threshold, let's say, because of its attributable revenue and activity, but only one of 5 subsidiaries also independently exceed the threshold, I'm understanding that the parent company then is only required to report on itself, and then the one in scope subsidiary, but not necessarily the remaining 4. Want some clarity around that. I know also earlier during this FAQ, we learned that whether subsidiary revenue is also considered revenue of the parent company is in part influenced by how the entity files with the California Franchise Tax Board. So a comment there, really just an embedded comment. I think this clarification is useful and would be really, really helpful to see articulated in any subsequent reference materials that you issue. Because again, there's a lot of companies still asking a lot of information around this and more clarity.
Hi, Daniela. So to answer your question, yeah, you're spot on that each individual entity should evaluate by themselves whether they meet the definitions under these regulations. The relationship for a parent subsidiary does not affect whether or not entities are subject or not. What the relationship there does is it allows parent companies to submit a consolidated report on behalf of their in-scope subsidiaries. So yes, each individual entity should evaluate by themselves. And to your point, yes, it's for entities that file as a unitary company for their FTB filings, then that revenue of the subsidiary will count towards the total revenue of the parent company. And for example, in that situation, then with an in-scope subsidiary, that parent company would be in scope there. So it all just depends on the tax filings, and we encourage all companies and entities to look at that to verify whether they meet those thresholds and definitions.
Thank you. Our next comment is from Miguel Sklarla. I have unmuted you. Please share your name, affiliation, and begin your comment.
Yeah, my name is Mikhail Skavarla. I'm here on behalf of CEEB, the California Council for Environmental and Economic Balance. Appreciate some of the clarity that this workshop has brought, and I know there's a lot of work ahead of us prior to the first implementation targets. So to that end, wanted to support some prior comments with, like those from the California Chamber of Commerce with regard to need for additional detail on safe harbors and trying to avoid California specific standards, as well as supporting, not including third parties in the reporting requirement. We think this should be housed with the state of California for the reasons outlined before. Was curious if there had been any thought with regard to a process if a company has been incorrectly identified. Also, as the revenue tax threshold, I think Steve's concepts here were kind of more aligned with that of the CSRD and thinking that through. But we can kind of set that aside. And then additionally, as we look for that first implementation date, it does, and the associated fees, it does seem like this is aligning fees with kind of a projected requirement as opposed to the actual requirement. I think some other commenters have brought up ways to streamline and align things, and would hopefully, as we continue to move towards this, we can find efficiencies and ensure that those fees are manageable, especially for companies with lots of subsidiaries. Thank you.
Thank you for your question, Mikhail. Yeah, so just to reiterate, the preliminary list that staff put out is for informational purposes only. It's only for the development of the fee regulation to come up with an estimate for that. It's not a compliance tool. So we just reemphasize that stakeholders should look at the proposed definitions that we've updated in this presentation, as well as the FTB tax filings to decide whether or not they are subject to the regulation. Thank you.
Thank you. Our next comment is from Stephanie Jones. Please share your name, affiliation, and begin your comment.
Hi, thank you. This is Stephanie Jones with Environmental Defense Fund. Just a brief comment with regard to the definitions and data sets used for identification of covered entities. I just wanted to express EDF's continued support for CARB's efforts to pursue the most relevant and reliable data available for administering these programs. As we've noted in prior comments, franchise tax board-based definitions offer a clear, up-to-date, and reliable manner of identification. So we support CARB's proposal set forth today to move forward with an FTB-based framework for coverage definitions. Thank you.
Thank you for your comment. Our next comment is from Tim Swickward. Please share your name, affiliation, and begin your comment.
Yes, thank you. I'm Tim Swickard from the Louis Brisbois law firm. I head up the firm's greenhouse gas practice and have been giving legal advice to many, many of our nationwide clients regarding this. I have a couple quick questions. First is I looked just a minute ago, looked on your website. When do you expect to have the slides from this workshop posted there? Because the latest one that I could find is the May workshop slides. That's my first one. The other question that I get from many, many clients looking forward, and I realize this is down the road, but when it comes to reporting Scope 3 emissions, obviously many of those emissions the data resides with third parties, and my client has no legal ability to extract that data from them. And in fact, sending a letter saying, please send this over, will probably not result in a very nice response. How does CARB intend to deal with the fact that covered and regulated entities have no legal power or authority to extract information from third parties when it comes to reporting Scope 3 emissions?
Hi, Tim. Thanks for for your comments and questions. Regarding when the workshop slides are going to be posted, they um, are currently posted. I'm not sure if you're looking at a different part of the CARB website, but under the California Corporate Greenhouse Gas Reporting and Climate-Related Financial Risk Disclosure Program's main page, you can go to a link on the side on the left-hand side that says meetings and workshops, and there you'll find links to all the slides, including this today's workshop, the August workshop, and the May workshop.
Yeah, and just to tackle the question about scope 3 reporting, this will be we'll be dealing with that during the rulemaking process to implement SB 253 next year. So we welcome your feedback and comments during that time. Thank you.
Thank you for your comments. Our next comment is from Elizabeth Esquivel. Please share your name, affiliation, and begin your comment.
Yes, thank you. Good morning. Elizabeth Esquivel with the California Manufacturers and Technology Association. We really appreciate CARB's continued engagement with stakeholders and want to highlight some comments along with some questions. We do support CARB's proposal to provide schedule flexibility in the first year of SB 253 reporting and to allow good faith submissions without assurance. We do think this approach will help companies, especially those without existing scope 1 and 2 systems, stand up to the new reporting process responsibly. However, we do remain concerned with the proposed flat fee structure and the scale of total annual program cost. We do urge CARB to continue evaluating alternative fee methodologies that better align cost recovery with actual program usage and minimize unintended economic impacts. Given that manufacturers often operate through multiple subsidiaries, we are interested in knowing how CARB will ensure that the flat fee approach does not impose disproportionate cost on companies with complex structures, and wondering when stakeholders can expect estimated per entity fee amounts so that they can plan for 2026 budgets. We also urge CARB to proceed cautiously as it considers definitions of doing business in California and potential reliance on the franchise tax board data. These determinations will ultimately decide which companies fall under the rule, and accuracy and transparency are essential to avoid misclassification and ensure consistent implementation. We're interested in knowing how CARB will ensure accuracy in determining which companies are in scope, and will companies have a clear process to contest misclassification if FTB data does not reflect actual business activity or presence in California. And on the first year reporting and compliance flexibility, we're also interested in knowing how CARB will provide clear guidance on what constitutes a good faith effort for 2026 SB 53 submissions so businesses understand expectations and enforcement risk. Thank you.
Hi, Elizabeth. Thank you very much for your comment and question. So as for the fees, again, I'll need to highlight again that the invoices will be issued after the board adopts the regulation and fee schedule. Once the fee schedule is finalized through the rulemaking process, and we will develop the fee amounts based on the number of entities that are required to report in 2026 under SB 253 and SB 261. And as for the estimate, I believe that in the August workshop, we include the ballpark figures of the estimates of what fee would look like for each program. So I would refer you to that August workshop slide. Thank you.
Thanks, John. And just to follow up on the last question there, you had asked about more clarity for 253 good faith effort. I refer you to the slides. I think it was slide 12 that really dug into that in the presentation here, as well as the FAQ talks in depth about this. I think it's question 18 or 19 in the FAQ, as well as the enforcement notice itself that we posted. It's on our website from December 2024. Thank you.
Thank you. Our next comment is from Mona Tierney-Lloyd. Please share your name, affiliation, and begin your comment.
Hi, thank you for taking my question. Mona Tierney-Lloyd with Enel North America. We have an affiliate that is operating in California, which is Enel X. North America, Enel meets the revenue thresholds that would make it a covered entity. However, our operations in California involve providing demand response services to commercial and industrial customers, which means we are reducing their consumption. We have no physical assets in California. All of our employees are remote workers, so we would assume under that circumstance that we have no emissions to report in California. So our question is, if we have no reportable emissions in California, would we be exempt from SB 253 and 261 requirements despite meeting the revenue thresholds? And I'll stop there. That's my question. Thank you very much.
Hi, just to take the question on the exemption. So the SB 253 requires reporting of emissions that happen anywhere in the world. So you would not be exempt based on whether your emissions are in California or elsewhere. It's the revenue threshold that in doing business in California, and whether you're a US based company, that determines whether or not you are in scope for SB 253 reporting.
Thank you. Our next comment is from Michael McDonough. Please share your name, affiliation, and begin your comment.
Hi, sorry, am I unmuted now?
Yes, we can hear you.
So the only question I wanted to raise here was just a hypothetical. So if you have a parent company that's previously submitted a risk report in the EU under the TCFD standards, and in that risk report they include all their global subsidiaries, can they simply reuse that report for SB 261 even if some or all of the subsidiaries don't themselves meet the $500 million revenue requirement, and or some of those subs may not be U.S. entities? And then a follow-up, if that's the case, if you can report that way, does the parent now have to report that way always going forward for all these subs? Again, assuming that some of the subs are not going to be over 500 million or may not be U.S. entities. Thank you.
Hi, thank you, Michael, for the question. Yeah, the first question, the answer is yes. If the parent company has been already reporting and meets the minimum requirement of TCFD 2017 for the subsidiaries, even if the subsidiaries are not required to submit, yes, they can submit. Now, in the future, we mentioned this earlier, in the future reporting, that is still to be determined on the biennial side. So we'll ask you to stay posted and stay connected with us on the future biennial report requirements. Thank you.
Thank you. Next, we have Russ Brennan. I've activated your mic. Please share your name, affiliation, and begin your comment.
Yes, this is Russ Brennan with Kawasaki Motors. My comment had to do with the point made in the supporting SB 253 compliance slide, specifically asking if existing GHG reports that cover Scope 1 and Scope 2 emissions are acceptable. So generally speaking, am I then correct in assuming that a company that has a excuse me, TCFD report already produced, that would generally suffice?
Russ, I'm not sure if you're conflating 261 and 253, but if your 261 or if your TCFD report does include scope 1 and 2 emissions, then you could submit that for this first year's reporting per our enforcement advisory. So I hope that answers the question. Essentially, if you have a report that has the scope 1 and 2 emissions embedded in it, then that's great. You should turn that into us for compliance with 253 in this first year.
Thank you. Our next comment is from Dory Richards. Please share your name, affiliation, and begin your comment. If you're speaking, we can't hear you right now. I think we can come back to you in a bit, and we are going to move on to our. We have next is Janie Hine. Please unmute yourself, state your name, affiliation, and begin your comment.
Yes, good morning. My name is Janie Hine with Covington and Burling. Thank you for the informative workshop and the updates today. I just have two main questions for the CARB staff. First is just one confirmatory question. Is it correct that a covered entity can file at the parent level for SB 261 and then for SB 253, a covered entity could take a different approach and file at the individual subsidiary level? And then my second question relates to the new August 10th deadline for Scope 1 and 2 for the first reporting year in 2026. So CARB indicated that if the reporting entity's fiscal year ends between February 2nd and December 31, 2026, the entity will report data from the fiscal year ending in 2025. My question is, if an entity's fiscal year ends after February 2nd, 2026, will they also have the option to use more recent fiscal year 2026 data for that August 10th submission if they're confident that they can do so by that August 10th deadline? And I recognize that this may be something that CARB would need to consider as it develops its role. Thank you very much for your time and guidance.
Hello, thank you very much for your comment and questions. Just to answer your first, or to answer both of your questions, as for the first one, yes, it is absolutely fine to report at the parent level for 261. And if you are also subject to 253 and for whatever reason you wanted to submit an individual report for 253, like as long as you are filing a report, whether at the individual level or the parent level for each reporting program, that is acceptable. And as for the deadline or the reporting deadline, the fiscal year data for SB 253, yes, we've recommended that if your fiscal year ends like after February 2nd in 2026 to use the fiscal year ending in 2025. If you're confident with your 2026 fiscal year data for the August 10th deadline, then it is also acceptable to use the fiscal year ending in 2026. Thank you.
All right, thank you. We are going to circle back to Dory. Could you please unmute again and give your comment?
Good morning. This is not Dory. I'm sorry. My apologies. I used an incorrect link. This is Anita Liu with National Technology Engineering Solutions of Sandia. NTES, we operate Sandia National Labs, which is a national research lab on behalf of the federal government. I've got three quick questions for you, please. First one is regarding applicability of these 200s rule. We submitted comments September 11th, stating that we did not think we were subject to these rules simply because our business is to operate solely on behalf of the federal government and they are exempt. Our status is as a federally funded research and development center. And so since the federal government is exempt and we are operating sources on their behalf, it doesn't seem that we should be reporting. And you can look at our comments. So my question today is, can you provide a response to that now, or would you be able to look at our comments and respond to them? Because just looking at the rule, and we've scoured the rule in detail, there's not enough for us to firmly exclude ourselves. I mean, we'd have to make a determination. Second question is just to verify that when you're speaking about limited assurance, you mean that there's no third-party certification that's required for this report. The last question is that if a company is not allowed by other constraints to post this climate risk report, is there a mechanism to submit it through the email or something to that effect? Thank you.
Thank you so much for the questions. We can't offer advice on everybody in terms of whether or not, their particular companies are in and out. We're not lawyers, but we are regulators. So hopefully the definitions that we've put out today, along with the exclusions and exemptions, can give your legal team what they need to determine in out. If modifications are needed to those definitions, of course, we're always open for public comment on that. Again, I would refer you and your team to some of the slides we've shared today around those definitions, and including but not limited to the exemptions and exclusions slide. Thank you.
Thank you. Our next comment is from Jenny Francis. Please share your name, affiliation, and begin your comment.
Hi there, my name is Jenny Francis. I'm with Ecom Energy. I wanted more clarification on the nonprofit, specifically 261. I know for 253, you're still waiting on the Q1 board, but for 261, should nonprofits still proceed with submitting their 261 since the board isn't till after? Thank you.
Hi, Jenny. I guess the short answer is no. You need to make the determination yourself with regard to whether your organization would meet the exemptions or exclusions that we talked about in the slides in the FAQ today. But that criteria that we put out really should be the basis for whether or not you're submitting your 261 report. Thank you.
Thank you. Next, we have Madeline Orlando. Please unmute yourself, share your name, affiliation, and begin your comment.
Hi, this is Madeline Orlando. I'm an attorney at Greenberg Traurig, and I just had two quick questions. So first, under both SB 261 and SB 253, for reports that are consolidated at the parent level, just wanted to confirm that subsidiaries I would still be notifying the agency somehow of the consolidated report. So for example, with SB 261, if the reports are consolidated, the subsidiaries would still be posting a parent entity consolidated report on their own respective website and still be separately uploading that to the CARB database. If there's some other mechanism by which CARB would want to be notified of the consolidated reports, that would be helpful to know. And then second question, just a confirmation that under SB 261, the fee is still assessed annually, even on years where there is no report required. Thank you so much for the time today.
Thank you for your comments. We are now going to be moving on to Srinad Yalamanchili. Please share your name, affiliation, and please share your comment.
Yeah, hi, can you hear me?
Yes, we can hear you.
Perfect. Srinand, good effort at the name. I work for BDO. I lead our sustainability services for North America, which includes the risk advisory stuff. So helping a lot of clients who have never done climate risk assessments before undertake 261 compliant climate risk assessments. My question is one on timing. So given that we're at 11/18/25 and the initial submission of the link needs to happen on 1/1/26, we have a number of clients who are in a position where that's just not going to be feasible to actually complete all that work and produce a comprehensive report. What does, in that instance, best efforts constitute? Would something akin to a draft template with a commitment statement and proof of engagement with BDO qualify as best efforts for that 1/1/26 target, with the full report being submitted at some stage whilst the docket is still open? I think there's a real sort of acceptance in the marketplace now that clients do need to do this and companies do need to do this for 261, but we're just running out of time, especially for this first year. So I wanted to get clarity on what best efforts would look like for companies who have never done this before and who are undertaking it in such a short time frame.
Thank you, Srinath, for the question. We definitely understand the challenges faced by companies that have never done this. So, in the recently updated SB 261 checklist, we clarified this on what early stage companies can do. What we are trying to say is that provide the best available data. So, like you said, we understand that the companies need to think about it, but we also understand the timing is challenging. There are a lot of companies starting on this. So, provide the best and available data, tell us the process, convey your gaps, limitations, and assumptions that went into the first report. We are trying to be like one of my colleagues said earlier, we are trying to be really nice and accommodating. And so that's why we are providing all these guidance. So check out the updated checklist on what you can do on the gaps, limitations, and any assumptions that you make at this early stage of us understanding the risks. Hope that helps. Thank you.
Thank you for your comments. Next up, we have Matt Pigozzo. Please share your name, affiliation, and begin your comment.
Hi, thank you. This is Matt Pigozzo. I'm with ITW. So I just had a question just to confirm the scope. If you have a parent company that's in scope and they have consolidated operations, just that you would be reporting the full scope of those operations in your 261 and 253, and that would still satisfy the reporting requirements for the individual legal entity that had the revenue that got it in scope, as well as just say they have a California subsidiary that's also in scope. I just want to confirm that that reporting scope is correct. And then a couple of practical questions on the linking. Is the link a link to an actual document, or is it a link to a page where the document can be found? And then if you have an existing sustainability report, for example, at the consolidated basis, is it okay to link to that consolidated sustainability report, assuming that it meets the requirements of 261 and 253, or do we need to have a separate report specific for the California requirements? Thank you.
Hey, Matt, thanks so much for the questions. Always hard to answer these things in the abstract, but I think if my assumptions about what you're saying are right, we're on the right path together. So that's good news. Yes, parent companies have the option under statute to report on behalf of their subsidiaries. If in this particular example, what you're saying is, they might be over-reporting in terms of reporting on subsidiaries that may be out of scope, that's fine. No issues there. In terms of the link, what we're saying is, per statute for the 261 reports, those climate-related financial risk reports need to be posted on the company's own website, and then they will provide a link to CARB. We will post a public docket similar to what we've posted to get public feedback from you all, and we'll post a public docket where you can copy and paste the link to that report to our public docket so that everyone can see it. I hope that is helpful, but if I miss something, please feel free to follow up with us.
All right, thank you. Next, we have Samantha Weinberg. Please share your name, affiliation, and begin your comment.
Hi, thank you so much. I'm Samantha Weinberg, and I work with Agendi, which is a sustainability consultancy that supports clients on their sustainability efforts, including with compliance on the 200s. And I just wanted to start by thanking CARB again for all of your work on all of this, providing a lot of incredibly helpful guidance and materials, and of course, taking our many hours of feedback and questions. I have one question just to clarify something that I believe my clients will be asking me after today, which is if a company has taken steps to work on their emissions calculations after December 2024 because they were anticipating compliance with this regulation, but had not planned to otherwise. Just want to clarify the expectations for reporting in 2026 for SB 253. I assume it's that, if they want to continue with those efforts and be A+ students, as you said, they can. But if they were not planning to do this prior to December 2024, then they do not need to continue with those efforts. Thank you.
Thank you so much. Appreciate the comment. I think I understood the question as being, what does a company do if it, according to the enforcement notice, wasn't collecting data at the time of the enforcement notice or planning on collecting data at the time of the enforcement notice? In that case, I would refer folks to our slides where we ask that companies that are in that situation report that specifically to us. Thank you.
Thank you. Next up, we have James Poulard. Please share your name, association, and begin your comment.
Yes, James Poulard, Scion Healthcare. We are a holding company of 80 hospitals across the nation. 14 of those are in California, with several of those holding the same tax ID number. So I think it's a matter of a question of clarification. Two, one, again, we're relying heavily on legal interpretation and consultants to start this work. So one of the things I wanted to clarify is that although we have entities outside of the state of California, that the reporting requirements must encompass all of our entities and all of our subsidiaries, and then secondly, can we provide a consolidated report for all 80 of these hospitals? Excuse me, it's 80 on one website for the January 1st deadline.
Hi, James. Thank you for your questions and your comments. To answer your questions, yeah, the report would need to include all of the hospitals within your company. So the emissions, not just within the California state boundaries, but all of the essentially operational boundary of your business. Now, for the consolidated report, that can include all of the 80 hospitals within your operation.
I also did want to clarify one thing, though, too. I think holding companies, you need to make the determination for yourself, but I think based on our definition of revenue, holding companies may or may not be covered. And so you'd want to look at, maybe talk to your tax folks within your organization and see what you guys are reporting with regard to gross receipts in your corporate taxes. And then you had a question on 261 as well. And I guess just to reiterate, yes, if you're reporting on behalf of subsidiaries, you can submit one consolidated report on a company website. Thanks.
Thank you. Next, we have Jackie Kingsley. Please share your name, affiliation, and begin your comment.
Hello, I'm Jackie Kingsley from Rexel USA. We're an electrical distributor company that does business in California. We are an European-based company in France, and we follow the EU laws, and we are planning to use the reports that we've been publishing publicly for quite some time with the state of California. So I have a couple questions with respect to that. We've followed up with our tax department because our company is listed 3 times in the company list, and we're wondering why. So the tax department asked us, what type of tax are we talking about? Is it income, sales, and use tax or property tax in California? And when we answer that question, they can clarify how we need to report in the state of California. And then my second question is, once we determine that, essentially we're going to use the same EU regulated approved sustainability report for one or all of the entities we have to file with or file for. So it's my opinion, since it's the same report, we should just pay one fee, not many fees, if it's determined that we have to submit many times. So I guess to summarize, I'm looking for help with the tax type to work with my tax department. And then secondly, if I'm submitting the same report, regardless of the entity, can I just pay once?
Thank you, Jackie, for your questions there. So for your question related to the preliminary list and the duplicate entries that were on there, when we initially put together that list, we considered parent companies. If through our matching exercise and estimating that list, we considered both the subsidiaries in the parent company names, which is why there's a number of duplicate entries on there, that those were found to be aggregated up to the parent level. But we'd like to reemphasize that our approach to assessing the fee and who is subject to the regulations is on an individual basis, bottom-up approach. So each subsidiary does need to apply the definitions to themselves, look at their tax filings, and determine if they're subject or not. And I believe that was your second question as well. Thank you.
Thank you. Next, we have Amber Eck. Please share your name, affiliation, and begin your comment.
Hi there, thank you. My name is Amber Eck. I'm with Bell and Evans. We're a food manufacturer in Pennsylvania. So my question is just some clarity about whether we are doing business in California. Our product does go into California, but we sell to companies, to grocery stores, retailers, that sort of thing. We do not file any tax returns or any other kind of income filings with the state of California. We do meet the income thresholds, but again, we don't file any legal documents or tax documents in the state of California. Would we be subject to these regulations?
Hi, Amber. Thanks for your question. Under the definition that will be proposed to the board of doing business in California and sales, if your business is not currently filing taxes in California, that means that you're not meeting any of the definitions of doing business in California by the FTB, which would include sales, property holdings, or payroll. And so by that virtue, it likely means that you're not meeting that sales threshold. So I would consult internally, but just based off of information that you provided, I don't believe that you'd be subject to the regulations.
All right, thank you. Next, we have Michelle Grossman. Please share your name, affiliation, and begin your comment.
Hi, can you hear me?
Yes.
There we go. Hi, my name is Michelle Grossman with Precautionary P Consulting, working with companies on disclosure. I'm seeking clarification on some of the SB 261 language for disclosure. The regulation, Section 2B, says that if a covered entity does not complete a report consistent with all required disclosures, the covered entity shall provide the recommended disclosures to the best of its ability, provide a detailed explanation for any reporting gaps, and describe steps the covered entity will take to prepare complete disclosures. In reviewing also the SB 261 checklist that was provided yesterday, it says that CARB encourages reporting entities to include in their disclosures a description of gaps, limitations, and assumptions made as part of their assessment of climate-related risks. So, can you clarify for companies in early stages, they're able to partially but not fully disclose. They're unable to provide quantitative climate risk, but they are providing qualitative climate risk. Are they required to provide detailed explanation for the gaps and describe the steps that they'll take to prepare complete disclosures as it says in the regulation? Or is it a little bit more of the way that it's described in the updated checklist? Thank you.
Thank you, Michelle, for the questions and the comments. So we understand the challenges faced by the company, and that's why we added that qualifier that early stage companies may not have the full data available. They might have other challenges being faced. So we recommend that you provide uh, the description of your gaps, limitations, and challenges regarding the data to be submitted. And we also, again, related to that, we clarified that you can provide qualitative analysis of your risk and measures taken to reduce those risks. So I hope that answers your question.
Thank you. Next, we have Nick Bromo. Please unmute yourself, share your name, affiliation, and begin your comment.
Yeah, thank you very much. Nick Romo on behalf of the Association of Independent California Colleges and Universities. I want to thank the staff for their engagement and appreciate the staff's recommendation to exempt nonprofits as defined under the federal tax code. Thank you so much and have a good afternoon.
Thank you for your comments. Next, we have Chris Schultz. Please unmute yourself, share your name, affiliation, and begin your comment.
Hi there, I'm Chris Schultz with the California Bankers Association. Wanted to acknowledge the difficulty with the statutory deadlines and acknowledge that CARB staff is trying to make this the most workable you can within those constraints. Wanted to augment a comment earlier about clarity about conformity with the GHG protocol updates. Many of the companies subject to this CARB requirement are reporting in multiple jurisdictions, and the complexity increases if some jurisdictions allow for the inherent flexibility in the GHG protocols, but California is locked into a specific standard that doesn't amend with the updates to the protocols. Just wanted to highlight that as CARB staff considers how to handle these updates that are in the works for the GHG protocol. Thank you.
Yeah, thank you for that comment, and we'll definitely be taking all that into account as we do our rulemaking on 253 next year.
Thank you. Next, we have Jeremy Weinstein. Please share your name, affiliation, and begin your comment.
Hi, thank you very much. This was brought up earlier in the Q&A. There was a question that I asked about the whether or not this is comes a right example, slide 18 in the August workshop, where there's discussion of just participating in the wholesale energy markets gave rise to being within scope. And I think the answer that was given was that, well, CAISO's not in scope. But slide 18 is it's CAISO or any other entity whose transactions are just in the electricity markets or, hopefully also in the natural gas markets, but other interstate markets, the transactions, interstate commerce. And I think it was brought up that there was a slide last time, but there's no slide this time. So is there a change? And I didn't see anything in the FAQs either. So is there a change in policy or what is the position in CARB in terms of just participation in transactions in interstate commerce, most notably the energy markets, brings in or out of scope?
Hi, Jeremy. This is Jordan. The intent letter that a number of stakeholders have referred to, we think only applies to wholesale electricity through CAISO. So if we're misreading that, maybe you can connect with us offline and we can talk more about that. Thank you.
Thanks for your comments. Next, we have Clint Mead. Please share your name, affiliation, and begin your comment.
Yes, hi, Clint Mead from K. Rose and Partners. Quite a few of our clients are in the maritime industry, although most are foreign flag, that is to say, non-US companies that would not currently be required to report under these regulations. I know I wouldn't be able to get a definitive answer, but I was wondering if there's been any discussions to expand these regulations to apply to foreign companies that do business in California. Just to have any idea if we think that these might be expanded to include foreign companies. Thank you.
Hi, Clint. The extent of the statutes is US-based companies. I know it's phrased a little differently in the statutes, and you could refer to the exact phrasing for the definitions of reporting entity and covered entity under the 200s. But the statutes limit this to US-based companies that are also doing business in California with revenues above the thresholds. Thank you.
Thank you. Our next comment comes from Steve Wilkerson. Please state your name, please state your name, affiliation, and begin your comment.
Hello, everyone. I'm Steve Wilkerson with Forvis Mazars. I have a couple of questions about the assurance requirements. So on slide 12 and FAQ 20, it states that assurance is not required within the context of this good faith enforcement notice itself. So I wanted to get into what that actually means. So the first question is, if a company has the means and resources of obtaining assurance, and they're going down that process of starting to obtain an assurance provider, are they expected to continue the process to obtain assurance? And then the second question is more about the law and the statute itself. So the FAQ states that this guidance does not have the force of law. So doesn't the SB 253 statute require assurance in the first year? And is that inconsistent with the CARB guidance if that good faith enforcement notice is broadly applied as a reason to not obtain assurance? Are there any plans to amend the law to clarify that, or any other safe harbors? Thank you.
Thank you, Steve. So again, this is not changing the requirement for limited assurance per se. If a company has that information, has data that they've already pursued limited assurance on or received limited assurance on, then they would submit that as part of their first year 2026 Scope 1 and 2 reporting greenhouse gas emissions data. The safe harbor that you referred to there, I would point you again to the December 2024 enforcement notice, which clarifies our intent, essentially saying, give us what you have, as a shorthand way of describing what that enforcement notice says. Thank you.
Thank you. Next comment is going to come from James Gianantonio. Please share your name, affiliation, and begin your comment.
Hello, thank you. I appreciate the updates today. My name is James Gianantonio, Sustainability Managing Consultant at All4 LLC. I wanted to get further clarification on the SB 261 reporting deadline. Are companies allowed to update their SB 261 disclosures after posting them on their websites by January 1st, 2026, and before providing the link to CARB via the docket deadline of July 1st, 2026? Will there be penalties if updates are made during that time period? Thank you.
Hey, James, I think we got this question earlier as well. I just want to reiterate the deadline is January 1st, and companies should submit their reports by the deadline, or at least post it on their websites and then get us a link before the docket closes on June 30th.
Thank you. Next, we're going to have Megan Bolongia share, and please state your name, affiliation, and begin your comment.
Yeah, my name is Megan Belonja, and I'm with Curtis Group. We're a climate sustainability consulting firm. And I have a clarifying question regarding the biannual reporting cadence for SB 261. So, for companies that cross the revenue threshold for reporting in fiscal year 26 and 27, would their next reporting deadline, the climate risk disclosure, be in 2026 or in 2028?
Hi, Megan. I think you're referring to the 261 reporting. And so I guess the short answer would be it's a biennial reporting requirement. And the first year is 2026. So the next time would be in 2028. I hope that answers your question.
Thank you. Next comment is from Laura Mulry. Please state your name, affiliation, and begin your comment. You are muted if you're speaking right now.
Hi, this is Laura Mulry from White & Case. Can you please clarify whether it is okay for a company in scope to post the SB 261 report on an affiliate or a parent's website? And also, could you please just clarify again how a company should navigate determining whether they meet the thresholds for revenue and doing business in California for both of the laws? Is it they first look to the, the definition under the FTB, which just includes the sales portion, or how do they look at the tax filings and how do the tax filings play into this?
Hi, Laura. So to the first question, I don't think we have any problems with an entity posting the report on their parent company's website. For the second part, I guess essentially you would need to be looking at the definitions that we have here. We're pointing to the revenue and taxation code in several places for revenue and doing business in California. And so hopefully that aligns with existing tax reporting that covered entities are already submitting. If there's anyone on my team that wants to jump in there and add anything else, you're welcome to.
Yeah, I can add something real quick. So in the slide pertaining to the information about FTB data, we have a couple examples of lines that you could be looking at to determine your gross receipts and the sales within California. Now, none of this is finalized, and this is still part of the process that we're still exploring and finalizing, but that sort of gives you a sense of what we're looking at. So we're attempting to get at something that can be easily verifiable by both business entities and by CARB staff.
Thank you. Next up, we have Susanna Nagel. Please tell us your name, affiliation, and begin your comment.
Hi, can you hear me okay?
Yes, we can hear you.
Great, thank you. I wasn't expecting that. Okay, my questions. So you said that the fee will be advised once regulation is developed. Have you got any idea when that might be in 2026? The second question is, can you confirm that we will be required to identify all parents and subs that individually meet the thresholds for SB 261 and SB 253 via CARB's public docket, and that each entity will need to basically link to the report? We're filing I'm sorry, I didn't say that. I'm Susanna Nagel from GSK. So we're going to have a UK parent consolidated report, and then obviously we'll identify the US entities that need to file it and link from it. So can you just confirm that each individual entity will need to link separately to that report and identify through the docket publicly? And then the last confirmation that I would like, just from what I've heard, is that the only action that is needed by the 1st of January 2026 now is just to publish the report on the website because the payment of fees has been delayed. That's it.
Thank you so much for that. Really appreciate it. I'll try to get to these as I understand them, but of course, feel free to follow up with us after if I've missed something here. So in terms of the regulation that will be covering the scope 1 and 2 2026 reporting deadline and the fees component of the regulation, we'll be bringing that to our board in Q1 2026. To confirm, yes, parents can report on behalf of their subsidiaries, and fees will be assessed annually per statute. I hope that helps, but if it doesn't, please feel free to drop us a line. Thanks.
Thank you. Next comment we have will be from Joseph Stiver. Please share your name, affiliation, and begin your comment.
Hi, can you hear me?
Yes, we can hear you.
Thank you. My name is Joseph Steyer. I'm with York Engineering. First, I see there's some new things out here that I think need some clarification. Are you planning to publish an updated guidance document, like showing that nonprofits aren't expected to report under SB 261 by January 1st because they're going to be exempt, as well as other notes like entities aren't expected to undergo limited assurance verification, even though there are some notes under SB 219 that requires limited assurance verification. Just some guidance, just because there's a lot of things in the air. And as a consultant trying to guide people, I want to be accurate on explaining what's required, and it's still kind of lost in some areas. So an updated guidance based on the presentation would be helpful along those lines. Also, I was wondering when you might have updated guidance on the expectations for qualifications for limited assurance, for entities to provide limited assurance verification starting, I guess, now in 2027. Thank you.
Thanks for the question. So this will give us an opportunity to kind of do a global on a couple of themes that I think keep coming up. So just to be clear, the way that in terms of the upcoming Jan 1, 2026 deadline, I would direct your clients in terms of determining their eligibility both to statute as well as the updates to staff's recommendations around both the definitions as well as the exemptions and exclusions page. And specific to your question, you'll see nonprofits there. In terms of limited assurance, nothing new there. We're simply clarifying today, since we've gotten questions about what did our enforcement notice that we issued in December 2024 mean in terms of assurance. We're providing clarification that in keeping with what the enforcement notice projected, that companies should give us what they have in terms of scope 1 and 2 data, including but not limited to that assurance piece. So if companies were planning on getting assurance or have it, submit that. If they weren't planning on submitting that, or if they weren't planning on getting that, then they don't have to. In terms of the program moving forward, again, the initial regulation that we bringing to the board in Q1 2026 that will include fees and the 2026 deadline for scope 1 and 2 reporting. And so we will be following up with an additional regulation on the details around the fuller part of the program next year. So more workshops to come, which you saw staff signaling in the conclusion slides to today's presentation. Thank you.
Thank you. Our next comment is going to be from Cassandra Martineau. Please share your name, affiliation, and begin your comment.
Hi, and thank you. Cassandra Martineau from Sun Life. I have a few questions. The first is now more of a comment after other questions, which is that it is clear from many of the comments that the definitions do not provide absolute clarity on eligibility. And so it sounds like that internal legal teams will potentially need to interpret some of the definitions, in which case we'd like to request that there will be very clear safe harbor provisions for determinations that maybe do not meet with CARB expectations, or some sort of enforcement process that allows companies to provide the justification for the decision that they made in terms of filing and eligibility before any fees are levied. The second is a question on rulemaking timing for the subsequent rulemaking process, whether you can provide any further information, even in broad strokes, on when that would start, when it's expected to end. The reason it matters is because, for example, if you specify assurance standards and a company needs to change their assurance standard, waiting until the end of 2026 for the final rules on that will potentially not leave enough time for compliance in 2027 unless there's another good faith effort clause included. The third question is on organizational boundary. The discussion seemed to indicate that the approach to organizational boundary was still under consideration, but that flow chart on slide 29 had pick GHGP organizational boundary as an inflection point for subsidiary reporting. So I'm curious if there has actually been a decision made on organizational boundary or if that was potentially an error. Thank you.
Thank you so much for your comments. We are actually going to be moving on to our next commenter. Please, Kyle Horn, share your name, affiliation, and begin your comment.
Hello, my name is Kyle Horn from Children's Hospital Los Angeles. Thank you all for your time today. So I have two quick clarifying comments and a question. I just wanted to go back to a comment from Jeff Hicks and I believe Joseph about the December 2026 date listed on a slide. I believe the clarification fix they were sharing is that as was verbally shared during that time and then also on the slide, the slide states December 2026, but we believe it should be 2025 as in when the submission site will be opening. The second comment is me speaking personally. So I'm definitely in support of submitting this data, but I did want to respond to a previous commenter's concern around nonprofits with over 1 billion in revenue having, quote, significant capacity. So I very much appreciate the concern, but as a nonprofit with over 1 billion in revenue, I think we are a good example of an NGO that does not have significant capacity, especially with recent Medi-Cal reimbursement reductions, et cetera. And then to my question. So this is kind of a recurring theme here, but as it relates to anything that CARB is proposing for the initial rulemaking, such as further defining doing business in California and proposing exemption for entities like nonprofits, such as CHLA, I understand the initial rulemaking isn't slotted until Q1 of 2026. So after SB 261 is due for the first time. Feedback on this call seems to conflict with statements on the CARB site for this very public workshop. So the CARB workshop site states that initial rulemaking does not affect January 1st, 2026 reporting deadlines. So for this first submission of SB 261, based on that website statement, nonprofits and all other similar organizations, such as like the telehealth working, covered under initial statute would still need to submit an SB 261, even if we would be ultimately exempted based on future rulemaking. So just confirming that that is accurate.
Kyle, thank you. Good to hear from you again. Appreciate the comments. Yes to the typo, and we'll fix it. Thanks for pointing that out. In terms of the initial rulemaking not affecting the timeline for the initial rulemaking not affecting the January 1, 2026 deadline. The reason that we're making that statement is because January 1, 2026 is baked into law. It's baked into existing statute. So in terms of considering your consideration of whether or not your particular entity is in or out for purposes of January 1, 2026, we are pointing folks for the purposes of January 1, 2026 to the definitions that we've provided and the proposed exemptions and exclusions that were proposed in this slide deck. So I hope that helps. Thank you.
Thank you. Our next comment will be from Nikki Cashdollar. Please share your name, affiliation, and begin your comment.
Hi, everyone. Taking all of our questions. The first question I have is related to submittal for SB 253. Has CARB determined what that submittal format will be? Will it be the same as SB 261, just a link to that report existing somewhere publicly, or something else, some other format? The next question I have is related to the template being optional. Are there any specific fields from the template for SB 253 that will be required, even though the template is optional? Or is it truly up to the company's discretion what metrics they'd like to include in their report? My last question is related to which entity and how many entities will be responsible for regulatory fees. I understand you can't review every company, but in a theoretical situation where we have multiple entities within FDB that hit that revenue threshold, but the data will be provided at the parent level, is that parent company the only entity required to pay that fee? Or should I expect that I need to know every single entity and expect multiple fees? Thank you so much.
Great, thank you. Really appreciate the questions. I can take a few of these and then I'll turn it over to other members of the team to jump in as well. You did a good job of getting a lot into 2 minutes, so congratulations. In terms of the first one, I think you were asking about format, and I believe that question was really centered on SB 253 and scope 1 and 2 reporting. And if you don't have to use the template, what do you require? We are asking companies to give us what they have in terms of scope 1 and 2. We put the draft template out to really kind of signal where we're going in the future, but also if it's useful for folks, please use it. If it's not useful and you have a different format that you provide that data in already, you can give that to us. And then I think I will turn it over to others who may want to answer the questions related to the fees. John?
Yeah, I can answer the question related to the fees and maybe pass it over to somebody else if anybody wants to add more onto it. But the fee is assessed individually, so each cover subsidiary will be assessed its own fee. So as we discussed in the presentation slide today, a parent company may pay all fees in one combined payment if they choose to do so. So it doesn't matter whether you're combining at the parent level or each subsidiary is paying their own fee. But yeah, ultimately each cover subsidiary, including the parent company, will still be assessed its own fee.
All right, thank you for your comments. Next commenter is Costanza Duke. Please share your name, affiliation, and begin your comment.
Hi, my name is Constance Duke, and I'm a sustainability consultant for Environ Energy. My question pertains to the nonprofit exemption, mirroring a recent comment about gaps in definitions. So thank you for clarifying that IRS tax exempt nonprofit organizations are exempt. However, we still need clarification on not-for-profit entities that do not have the IRS tax exemption, but also do not meet the California definition of a for-profit business entity as a C corporation, S corporation, LLC, or partnership, as shown in your slide deck today. And this includes nonprofit public benefit corporations, such as hospital systems or healthcare organizations. Has a definitive decision been made about whether these nonprofit entities are or will be exempted or not, provided, of course, that they have no filings as a C corp, S corp, LLC, or partnership? Thank you.
Thank you for your comments. Next up, we have Kathy Nguyen. Please unmute yourself and share your name, affiliation, and begin your comment.
Hi, everyone. This is Kathy Nguyen with Santa Clara University. This is a little bit in line with the other nonprofit questions that we've had. We are a nonprofit university. While we fall squarely within the proposed exemption, we're also listed on CARB's company list for subject to 261, although it was commented today that, of course, that list is not determinative of compliance obligations. And so my question is, for entities that fall squarely within CARB's proposed exemption, can they simply exclude themselves from 261 filing or do you anticipate that the exemptions will materially shift prior to the regulations being finalized in 2026? Thank you for your guidance.
Hi, Kathy. Thank you for the question. Yes, if your organization fits into the exempted or excluded criteria that we presented today in the slides and in the FAQ, then you should use that as you are thinking about whether or not you're subject for January 1st. But if you fall into those exclusions and exemptions, then you do not need to report for January 1st.
Thank you. Our next comment is from Alec Tkaczynski. Please share your name, affiliation, and begin your comment. If you are speaking, we can't hear you.
Can you hear me now?
Yes, now we can hear you.
Great. Thank you so much for taking the time to answer these questions. My name's Alex Tkaczynski. I'm on behalf of AT Strategy. I wanted to ask about the revenue criteria for SB 253. The new FAQ document explains that the applicability of the 200s will be determined by the lesser of an entity's two previous complete fiscal years of revenue. Does that mean that an entity which has more than $1 billion in gross receipts in fiscal year 2025, but less than that number in the previous fiscal year would not be subject to the SB 253 requirements in 2026? And then if such an entity then exceeded $1 billion in revenue or in gross receipts in fiscal year 2026, would it then be subject in 2027 to the scope 1, 2, and 3 reporting requirements? And then the one other question I had is for SB 261 reporting, given that the docket will remain open until July 1st, someone else had driven at this question earlier, but if we post our report on our website in advance of the January 1st deadline, do we have the ability to amend that report, update it with new information between January 1st and July 1st when the California docket closes?
Hi there, Alex. Thank you for your question. Yeah, I can help answer the question about the 2 consecutive years for the subject to 253. So yeah, the language is the lesser of revenue will be interpreted as the lesser of 2 years. So in other words, your lowest revenue for over a 2-year period. So in other words, you would need to be meeting the revenue threshold for 2 consecutive years in order to be subject to the regulation. So if we're looking at the first reporting year in 2026, we would look at revenue for 2025 and 2024. And if you met the $1 billion for at least one of those years, if you met the revenue threshold for both of those years, then you would be subject to the regulation. And I'll see if one of my colleagues has an answer to the other question. Oh, I see that we've answered that second question a series of times already. The reports need to be posted on a website by the statutory deadline, January 1st, and the docket will remain open at CARB until July 1st. Thank you for the questions.
Thank you. Next up, we have Kaylee Shallett. Please unmute yourself, state your name, affiliation, and share your comment.
Hi, thank you. My name is Kaylee Shallett. I'm the Global Technical Director for Climate Risk at Arcadis, which is a global design engineering firm with deep expertise in adaptation and resilience, as well as sustainability advisory. Thank you, CARB, for continuing to provide guidance and clarification around SB 253 and 261. My question is specific to SB 261. Assuming a link is submitted to the docket by January 1st, 2026, can CARB confirm the date the content will be treated as final for compliance evaluation? Thank you.
Hi, Kaylee. I think this is a repackaging of a lot of the same questions we've gotten on 261. So just want to reiterate, once you've sent us your report, you have the link to your posted report. You have met the requirement for 261. And on our side, we're going to consider that finalized. Thank you.
Thank you. Next up, we have Anissa Hunt. Please unmute yourself, share your name, affiliation, and begin your comment. If you are speaking, we can't hear you. I think we can move on briefly and come back to Anissa. For now, we are going to hop on to John Schidler. Please state your name, affiliation, and begin your comment.
Hi, everybody. This is John Scheidler. I'm with Omnex FuturePast. We are a greenhouse gas validation verification body. So thank you, ARB, for the workshop. This is all very useful information. My question is about any plans that you have for updating the reporting template for SB 253. Since in the last workshop you asked for asked for proposed changes to it, and we submitted some. I'd like to know if you have a plan to update that in the future. And I'd like to make a couple of comments as well. First, on the question of the revised greenhouse gas protocol standards, I hope you will consider including a transition period, a generous transition period, because there will be some companies that take longer to transition from old standards to new standards. And then secondly, whatever the outcome of that transition period process is, I hope you will include all of the requirements of the greenhouse gas protocol, whichever version, and not selectively choose some rather than others. Thanks very much.
Thank you, John, for your questions and your comments. With regards to the Scope 1 and 2 reporting template, as we mentioned, it's a optional template for next year. We are not requiring the data to be submitted in that format, and so there are no plans right now to have another draft of that for the 2026 reporting. But we will be having conversations about the required template for the 2027 and in future years reporting during the rulemaking process next year. And so appreciate your comments on that, and also on the GHG protocol updates and recommendations there. So I encourage you to get involved during that rulemaking process. Thank you.
Thank you. I'd like to announce that we've reached the end of our stated end time, but because there's still over 24 hands raised, we will plan to finish responding to those with their hands raised. We will not be taking repeat questions from people that have already commented. All right, next up, let's go back to Anissa Hunt. Please unmute yourself, state your name, affiliation, and begin your comment.
Hi, can you hear me now?
Yes, we can hear you now.
Okay, great. Sorry about that. So my name's Anissa Hunt. I work at Total Energies. Our parent company is in the EU, so they produce reports based on European standards. It sounds like from previous questions that it is acceptable to submit a report at that level, even if it's not a US company. So my first question, is that correct? And if so, is the European standards, is that an acceptable standard to submit this information on? And then, yeah, I guess they're my two main questions. Maybe I'll have a follow-up after that.
Hi, Anisa. Thank you for the question. So the requirement we have issued, if you're referring to SB 261, the checklist provides the minimum requirement, and as long as you meet the minimum requirements, you can submit the EU report as it is, and we'll accept that. Thank you.
All right, thank you. Next up, we have Sarah Varani. Please state your name, affiliation, and begin your comment.
Hi, this is Sarah Varani. I'm from Bank of Montreal. Just a question on the statement that'll accompany SB 261. Should the statement be posted on our website, or when we put the link in the docket, can we put the statement in there directly?
Hi, Sarah. I think you're referring to, actually, Emily, could you allow Sarah to unmute again? Just could you clarify that question, Sarah?
Yeah, so for SB 261, we're asked to submit a statement to essentially confirm what we have followed and what we will be doing in the future in terms of following the regulation. And I was just wondering if we're posting that on our website or through the docket.
I see. That statement ideally would be in your report itself. And then the report could be posted to the website and the link to that website submitted to us. I hope that answers the question. Feel free to follow up with us separately if that didn't.
Is there a way that we can post it through the docket? Just because if we're repurposing a report that we already have publicly, we wouldn't want to take that down just so we can put a note just for CARB.
I see. Yes, I think that would be fine if you can include that in tandem with the link that you submit in our docket.
All right, thank you for your comments. Next up, we have Anand Varahala. Please unmute yourself, state your name, affiliation, and begin your comment.
Just to confirm, can you hear me?
Yes.
Yes, my name is Anand Varhala, and I'm from Schneider Electric. My question is regarding SB 261. I understand that the climate risk report needs to be published on the website by January 1st, 2026, and biennially thereafter. For several years now, we've been publishing our comprehensive annual sustainability reports at the group level that include not only the climate risk in line with TCFD, but also our scope 1, 2, and 3 emissions, as well as the assurance report. But this report is typically published on our website towards the end of the first quarter following our financial year, which happens to coincide with the calendar year as well. So my question is, for the January 1st, 26 deadline, the report that we published earlier in 2025 with 2024 data, would that be sufficient?
Yeah, I can get that question. So as we stated in our presentation slide, if you are using the calendar year, so you'll be looking at the 2026 calendar year timeline. And since the calendar year end would be on December 31st, you can use the 2024 year report for the January 1st submission.
Great, thank you. In order to make sure everyone has a chance for their comments, we are going to move on to Jason Langford. Jason, please unmute yourself and state your name, affiliation, and begin your comment.
Thank you. Can you hear me?
Yes, we can hear you.
Okay,
Great. Yes. My name's Jason Langford. I'm with with Troutman Pepper Lock. Had a few questions, so I'll just get right into them. First, I was wondering if CARB plans to include the requirement to post a link to the SB 261 report in its public docket in an upcoming regulation. And if not, I wonder how does CARB have the authority to impose this requirement since this is not a requirement in the statute? Um, on SB 261, I was also wondering about the exemption for insurance companies. Does this extend to insurance companies regulated by the California Department of Managed Healthcare? Is a company that is not regulated by the California Department of Insurance, but that is in the business of insurance in another state? Would they be exempt since they meet the second prong of the exemption in SB 261? Um, my other question was, if you look at the statute based on the language of SB 253, it requires CARB to adopt regulations to have companies disclose emissions. As noted by the court in the litigation challenging SB 253, the law is not self-implementing and CARB must adopt regulations for companies to comply. So since we don't have any regulations or any guidance from CARB that has been proposed that has the force of law, I was wondering how and why does CARB expect entities to report without a legally mandated requirement to do so? And then lastly, per Bloomberg, the Ninth Circuit this afternoon froze enforcement of SB 261 against the chamber. And I was wondering if CARB would intend to extend that enforcement pause to all entities under the law. Thank you.
Hi, Jason. With regard to the second question that you asked there, yes, based on the statute. I think that if Nick from our team wants to pop on with regard to the last statement uh, about ongoing litigation.
Yeah, hi there. This is Nick, I'm a lawyer here at CARB. So we just learned that a court issued a ruling this morning temporarily pausing enforcement of SB 261, which is the climate risk reporting statute. This ruling does not affect SB 253, which is the GHG emissions reporting program. We are reviewing the court's ruling and we'll follow up soon with that.
Great, thank you. Next, we have Kirsten Rossalat. Please unmute yourself and state your name, affiliation, and begin your comment.
Hi, I'm Kirsten Roslow. I'm with Process Profiles. It's a one-person consulting firm that does environmental performance. So I had a question. This has been a marathon, and some people asked questions that didn't get answered. And I was wondering, are you going to respond to all the questions eventually in writing, or was this it, and we just don't get to know the answer to those questions that didn't get answered? And then the second question I have is, if somebody does Unity reporting and they have a subsidiary that qualifies in California, does the Unity reporting include all of their subsidiaries globally? And will it be obvious? Because as a user of the data, it would be really, crucial for me to understand exactly what entities they're reporting for.
Hi, Kirsten. This is Jordan. With regard to your first question, we're trying to be as responsive as we can where we can answer questions. And so I hope that us going over the allotted time period here to continue to answer questions is helpful for the entities that have raised their hands here. And to reiterate, when we release our rulemaking package for this initial regulations, the nearest term one, ahead of that Q1 2026 board hearing, we will be soliciting comments for 45 days. That's that 45-day Administrative Procedures Act comment period. And we will be responding in writing to every comment submitted there, as well as every comment spoken or submitted in writing at the board hearing itself. And so just want to reiterate, we're committed to transparency and we're trying to respond to as many comments as we can here. Thank you. Does one of my colleagues want to take that second question?
I
didn't quite follow the question. If maybe Kellen could be unmuted and ask it again.
Hi, so I'm back. So my question is, there's an option to do unity reporting, right, where the parent company submits a report that covers a subsidiary. But so, like as a user of the data, my concern is that there's a subsidiary that qualifies in California and a unity report is submitted. Does that unity report necessarily include all of the subsidiaries of that parent company? And will it be obvious which subsidiaries are included in the reporting?
We are following what SB 219 requires for in terms of the reporting on behalf of subsidiaries. And so for SB 253, the sort of the specifics of what those unitary reports will include, we will hash out during the rulemaking next year. But yeah, yeah, I think that's all we have on that right now. So thank you for the question.
Yeah, thank you for your comment. Next, we have Caitlin Cooper. Please unmute yourself, state your name, affiliation, and begin your question.
Hi, Caitlin Cooper with Amrise. Regarding SB 253, I understand the template's not required this year, but is the plan for a version of the template to be required for 2027 reporting and forward? And then secondly, regarding the further to the SB 253, I saw in the FAQ that a docket will be open for reporting in 2026 for scope 1 and scope 2. Will this just require a link similar to what the plan is for 261, or will we need a physical copy of the documentation uploaded? And then lastly, what is the reporting process for new companies? We went through a spinoff in June just this year, 2025. So the new company will only be in existence for about 6 months come January, but we do have historic data under the old company. So will 2026 reporting still be required? And if so, for the January 1st deadline, would the annual sustainability report from the old company be sufficient to cover the requirements for 261?
I could take the first question there about the template. So the template that we the draft template that we published for scope 1 and 2 reporting for 2026, as you mentioned, is not required. The rulemaking for SB 253 that will include guidance on reporting for 2027 for scope 1, 2, and 3, 2027 and beyond, will include more specific requirements on reporting, but we will hash out what that will look like in future years and during the rulemaking next year. And hopefully the template that we published sort of provides an initial sort of direction that we are going, but it's not what will be included exactly. That'll be developed next year, as I said. Thanks.
And regarding the second question, the guidance we have issued is that provide us the best and available data. So if your company has already published some report that meets the minimum requirements, that should be fine for you to submit.
Thank you for your comment. Next up, we have Sarah Polomu. Please unmute yourself and state your name, affiliation, and begin your comment.
Hi, I'm Sarah Polomu with the California Retailers Association. We represent retailers of all sizes across the state. I have a few comments and questions. One is on the SB 253 draft template. We wanted to know if a company uses a more up-to-date GWP factor than what the template is keyed to, so AR6 instead of AR4, would the company still be considered in compliance? We understand that the template is both draft and for now optional, but we do want to make sure companies are not being penalized for using more updated GWP factors. The next one's climate-related financial risk. We are concerned that that will ask organizations to submit hard numbers on climate disclosures. Many companies do not want to disclose exact numbers due to the costly and overly burdensome operational lift and confidentiality standards. And then on disclosure submission, we request clarity on whether data is for fiscal year or calendar year, recognizing that companies have different year ends. We need to keep the time of compiling data as equitable as possible for all companies. Scope 3 reporting, we're requesting clarity from CARB on whether the board is expecting all categories to be reported or only those that a company considers material. If CARB hasn't acknowledged that only material categories need to be reported, CRA recommends that CARB clarify that only material scope 3 categories be required to be reported. And then finally, companies, this is just a comment, companies should be allowed to choose the IPCC AR report utilized. Many companies use the latest of AR6, but it appears CARB is asking for AR4. Thank you.
Hi, Sarah. Thank you for that comment. I will try to answer as many questions as I can, and my colleagues can follow up. So regarding the reporting template and the global warming potential, I believe the template offers an option to choose any reputable sources of GWP. And I just want to reemphasize that the reporting template for this first year is going to be for optional usage. So companies can choose to use the guidance on the reporting template if they find that to be useful. Otherwise, they can just do what they have been doing and report that data for this first year. And yeah, I think John can take the calendar year and fiscal year question.
Yeah, I can take the calendar and fiscal year question. So I think to kind of answer for both like SB 253 and 261, like first I would suggest that you take a look at the 253 enforcement notice. So companies should use what they have at the enforcement notice time of release, and we're not expecting anything more than what you were collecting or planning to collect. And as you mentioned, the SB 253 legislation specifies prior fiscal year, but SB 261 does not specify whether it's fiscal year or calendar legislation, but the CARB guidance says to use the most recent best available data for the first reporting. So I would probably stick to our previous guidance. Thank you.
Yeah, and also just adding on to that with regarding questions on materiality as well as scope 3, that will be further clarified in next year in the SB 253 rulemaking, where there will be ample opportunities to solicit public feedback.
Thank you. Moving on, our next comment will be from Janani Sundarakumar. Please unmute yourself, state your name and affiliation, and begin your comment.
Hi there, I'm Jan. I'm with BDO UK. Just to be super clear, as we are currently working with quite a few non-US parent companies that have US subsidiaries that meet the SB 253 thresholds, and are currently thinking about preparing separate reporting to meet these requirements. If a subsidiary is required to report under SB 253, but the parent entity is not, are you confirming that it is sufficient for the subsidiary to submit the consolidated parent entity report, even if that report does not specifically detail the GHG emissions attributable to the in-scope subsidiary, and it's just included on a global consolidated level? And is this requirement just a year one relief, or is this the expectation going forward?
Pausing, I'm not quite sure I'm following. Will not penalize the clock against you because I think this is on me. Can you maybe restate the question?
Yeah, definitely. So in cases we're seeing outside of the US, there are non-US parent entities that obviously don't meet the requirements because they're not a US company, but they have subsidiaries that do meet the requirements because they are US companies. Those parents currently already report globally on their global operations. They include the US subs. We were under the impression, I guess, previously that the US subsidiaries would have to prepare their own reporting that specifically detailed out their scope 1 and 2 GHG emissions. But are you saying that it's okay for those subsidiaries to just submit a link to their parent entity's consolidated global emissions, even if that report doesn't detail out the specific emissions for each region.
I see. So yes, reporting at the parent company is an option that's allowed in statute. I think in terms of the crux of your question, we've gotten a couple, I think, asks for clarity in terms of whether or not the subsidiary or the parent company sends in the link. And so we'll try to put together some additional FAQs to help answer that.
Great, thank you for your comment. In order to make sure everyone has a chance to ask their question, I will be moving over some people who have already spoken. Please feel free to reach out to us with any additional questions or comments you have. Moving forward, the next commenter will be Jordan Garnick. Please unmute yourself and state your name, affiliation, and begin your comment.
Yeah, my name is Jordan Garnick with Independence Realty Trust. I apologize if this has already been touched on, but we believe that we fall into the proposed 261 exemptions and the doing business in California definitional remittances discussed today. However, due to the timing of the planned Q1 2026 ruling by the board on these proposals, my question is, will the proposals therefore not apply by the reporting deadline of January 1st, 2026? And if approved, will they therefore only apply to this second biennial report due in 2028? An additional question is, what year will the teleworker exemption be based upon? And those are my two questions.
Jordan, happy to take those. So January 1, 2026 is the statutory deadline set by existing law that's been on the books for a while. We view SB 261 as being self-implementing. And so what we're doing is to provide clarification to folks who might be on the bubble is we're pointing to our existing proposed definitions and proposed exemptions and exclusions for the purposes of the Jan 1, 2026 deadline. So the folks you represent, I would recommend that they use both statute and our proposed definitions to help guide that January 1, 2026 reporting deadline.
Thank you for your comments. Next, we will be moving on to Rich Orlov. I've activated your mic. Please state your name, affiliation, and begin your comment.
Can you hear me okay?
Yes, we can hear you.
Hi, my name is Rich Orlov. Rich Orlov. I'm a consultant with Korn Ferry, helping a company with its disclosures and reporting. I just had a couple of questions. They might seem a little downstream because they're related to the fees, and I know that you're still working on that. Do you think it would be possible to provide, like you did in today's presentation, flowcharts with regard to the determination of fees? I think that could be helpful to companies. So that's the first question. And the second question, so let's say there's a U.S. parent company and it has a U.S. subsidiary and 5 non-U.S. subsidiaries, but they're all doing business in California. Then under the current thinking of how the fees are going to work, would fees just be due for the parent and the U.S. subsidiary because the 5 non-U.S. subsidiaries are not U.S.-based subsidiaries? Am I thinking about that correctly?
Hi, Rich. Thank you for your questions. I can answer that second question, and the fees will only be assessed for each in scope company. So in your situation where you have 5 non-US based subsidiaries, they would not be in scope given the fact that they are not US based. And so then the fees would be assessed to the parent company that is US based, and then the US based subsidiary that meets the revenue thresholds and does business in California.
And just to quickly add on to the flow chart, so if either the parent company or the subsidiary, they can each individually go through the flow chart and then determine whether they're in scope or not. So again, like kind of highlighting the Salvador's point, like you can determine whether you're going to be in scope and like for each regulation, and whether if you're already in scope before you go into the parent level like reporting, you can kind of assume that like each at that level already that each entity will be assessed its own fee. And then the payment, again, like you can leave it up to the parent company so that they can pay on behalf of themselves and the subsidiaries, or each individual subsidiaries can pay the like separate fees as well.
Thank you. Next, we have Rebecca Grapsas. Please unmute yourself and state your name, affiliation, and begin your comment.
Thank you. My name is Rebecca Grapsas. I'm from Wild Gotchel and Manges. Thank you for your time today so far. I just had a question about SB 261, specifically around the checklist that's been put out and has been recently updated. So 261 requires disclosure of a company's climate-related financial risk, and that's defined in the statute. And that can be in line with the TCFD recommendations or ISSB. However, the checklist also talks about, under minimum CARB requirements for disclosure, a discussion of climate-related opportunities. So this seems over and above the climate-related risks disclosures that are required by 261. Just wanted to get some clarity around that. Thank you.
Thank you for the question, Rebecca. Based on the statute, we are focused on climate-related financial risk, but we understand that TCFD already addresses the opportunity side. So if you have that information, it's up to you or the company to decide whether to disclose that information. It's optional. We're mainly focused on risk at this time, based on the statute. Hope that helps.
Thank you. Next up, we have Justin Bell. Please share your name, affiliation, and begin your comment.
Hi, thank you. This is Justin Bell from Morgan Stanley. I had a follow-up question on the SB 261 injunction that was issued by the Ninth Circuit. We saw that oral argument is scheduled for January 9th, which of course is after the original January 1st reporting date. The earlier response on this issue referenced updated guidance to be issued by CARB. So my question was, do you expect that the updated guidance will clarify that companies may wait until after the injunction is lifted to file their SB 261 reports rather than file on Jan 1 while enforcement is still enjoined? And if possible, could you confirm that that updated guidance will be posted well in advance of the year-end original reporting deadline? Thank you.
Hi, Justin. We just learned about this court ruling this morning. This ruling does not affect SB 253. We are reviewing the court's ruling and we'll follow up. We can't comment on it right now.
Thank you for your comment. Next up, we have Rita Carroll. Please unmute yourself and state your name, affiliation, and begin your comment.
Good afternoon. My name is Rita Carroll, and I'm with Nexus Water Group. And I want to thank you for your resources, guidance, and patience. My question is regarding SB 261 reporting cadence and a clarification. If a covered entity isn't covered by 1/1/2026, the next time they need to evaluate if they will be a covered entity is for the 1/1/2028 reporting deadline. Is that correct? Thank you.
Yes, Rita, you're correct. Paul, you want to add anything there?
Yeah, I was just going to add that, yes, and then the eligibility or inclusion in 2028 will be based on the previous two, revenue will be based on the previous two fiscal years, so for 2027 and 2026.
Great, thank you. That will be our last comment for today. Thank you all so much for your comments. If you still have any comments or questions, please follow up with us at climatedisclosure@arb.ca.gov. We would love to continue to hear from you all. This concludes our time for verbal feedback, and I'll now pass it back to Jordan to close the workshop.
All right, thanks, Emily. Well, thank you all of our stakeholders out there for your continued engagement with us as we roll out this new program to implement the 200s, and thank you for hanging in there with us to the end of this workshop. We want to emphasize that stakeholder input is critical to shaping this program, and that's part of why we stayed on extra so that we could engage with you and hear from you. And these rules are all about transparency, and we need to have transparency in the development process as well. So if you haven't already, please sign up with the listserv to stay engaged and be notified of future public workshops and updates. We will not be opening a public docket for this workshop, but staff will open a public docket, as I mentioned earlier, for that 45-day comment period when the notice package is posted for the initial rulemaking. So stay tuned for that. And if you have any questions or comments in the meantime, you can reach out to us directly at climatedisclosure@arb.ca.gov. We'd be happy to meet with you. Do keep in mind that given the number of potential reporting entities and our efforts to finalize the rulemaking materials, we may have to book out a little. We appreciate your patience. So thank you and have a great day.